Good morning, everyone, and welcome to day 2 of the Banking Supervision Forum. We will start the day with the keynote address by EU Commissioner McGuinness. Now, because of a scheduling conflict, the Commissioner cannot speak to us live, so we recorded her speech and the Q&A on late Monday.
Ladies and gentlemen, a very good morning. It's a real pleasure to be with you at the 4th ECB Forum on Banking Supervision, and thank you to the ECB for inviting me to speak here today. During the last 10 years, the agenda for banking regulation and supervision has been dominated by the global financial crisis. That financial crisis showed that financial regulation was too lax. So we've spent the past decade bringing in reforms to tighten that regulation. And this latest crisis, prompted by the pandemic, showed that those reforms have been effective. Our banks stayed resilient, and they helped deliver some of the public supports to households and businesses. But we have not yet finished the job. We need to finalise the reforms we decided on after the financial crisis. And that will let us look towards preparing the banking system for the future. The reality is that our world is changing fast. If we want banking to benefit from change and not be overwhelmed by it, we need to take action. With the pandemic came an acceleration in the digitalisation of the financial world. Finance has also woken up to the urgency of the climate crisis. The financial system that we will see in 10 years' time, perhaps even in 5 years, could be very different to the one we have today. We will not be well prepared for the future if all we do is look towards the past. But to move beyond the post-financial crisis agenda, we must first finish what we started. EU banks are more resilient as a result of post-crisis reforms and of high-quality supervision. This year, the European Banking Authority is celebrating its 10th anniversary, and the single supervisory mechanism is turning 7. The EU single rulebook made our bank regulatory framework more robust. We addressed many of the flaws the financial crisis brought to light. Now banks are much better capitalised, they have enough liquidity and they are not excessively leveraged. But there are still some gaps in the rules that we need to close. The Commission recently adopted a new banking package that addresses some of the deficiencies that remain in the prudential framework. The first part of this proposal implements the final Basel III reforms. The main element that remains to be implemented is to limit the ability of banks to excessively reduce capital requirements when using internal models. The proposal aims to increase the comparability of capital ratios across banks. The reforms avoid a significant increase in the overall capital requirements of EU banks, and the reforms will be phased in over a long period, giving banks time to adapt. Our proposal is faithful to the Basel III agreement, while using flexibility within the international standards. It includes targeted adjustments to reflect the specific features of the EU banking sector and the EU economy. In particular, it recognises the significant contribution of SMEs, most of which are not rated, to the EU economy. We are taking into account the fact that European banks finance low-risk mortgages and keep them on their balance sheets. We are also taking into account that our banks have an important role in financing big projects and infrastructure. And EU banks' long-term equity holdings will not be treated as speculative investments. On top of that, the reforms are proportional and help reduce compliance costs, in particular for smaller banks, without losing prudential standards. The second part of this banking package is about making sure that banks are more resilient when it comes to sustainability. We are introducing requirements for banks to manage ESG risks systemically and consistently. Banks should also set out transition plans. And we are giving supervisors the tools they need to enforce those requirements. The third part of the package is a series of measures to strengthen supervision. One weak point addressed is the rules for non-EU banks with branches in the European Union. These third country branches have a substantial footprint in the EU, and they provide important services. But right now, they are regulated at national level, and there is a lack of consistency between the approaches applied by different member states. And that's why we are proposing minimum standards for the regulation and supervision of third country branches, moving to a more coordinated approach. And we are also taking this opportunity to respond to some of the lessons we learned in the Wirecard scandal. Notably, we're clarifying our rules on financial groups headed by a fintech company that have a bank as a subsidiary, so that they are properly regulated and supervised. We are also proposing minimum requirements on supervisory independence based on international best practices. So on the prudential regulation side, we are on track to achieve what we set out to do following the financial crisis. But after that financial crisis, we also decided to build the banking union. The banking union was a response to the Eurozone's sovereign debt crisis. We realised we needed the banking union to back up the economic and monetary union, our common currency, the euro. The banking union is vital to protect the European banking sector from a future crisis and to safeguard financial stability. The banking sector has remained stable during this crisis, but if we do not complete banking union, we have no guarantee of this stability in the future. So we need to live up to our promises as policymakers to do all we can to prevent another banking crisis with all the impact that would have on lives, livelihoods and taxpayers' money. The banking union will also provide a strong regulatory framework that can accommodate change. Because the financial sector is changing and we need a system that fosters consolidation where scale matters, including across borders. And we need to ensure that banks that do not adapt can exit the market in an orderly way without threatening financial stability. But here we still have a lot of work to do. We want to strengthen the crisis management and deposit insurance framework. We know that the cost of a bank failure should be borne primarily by a bank itself. But when extra money is needed, the common safety net financed by industry should be used and not public funds. If a bank fails, taxpayers should not foot the bill. We also need to build the third pillar of the banking union, a European deposit insurance scheme. The banking union will only be complete when this EDIS is in place. Reforms by the EU in this area have already helped protect citizens' money and reduce the risk of bank runs. But of course, national deposit guarantee schemes can only go so far. EDIS would make common safety nets stronger and more consistent across the EU. This would make national schemes more resilient to large local shocks. It would help to maintain the trust of depositors, regardless of where a bank is located. And banks in trouble would be less dependent on national governments. To start with, EDIS could provide liquidity to national deposit guarantee schemes in need, strengthening depositor confidence and making banks more robust in a crisis. But the Commission remains convinced that a more ambitious EDIS set-up involving loss mutualisation is needed in the steady state of the banking union. Progress on the crisis management framework and EDIS should help increase market integration. We know that the home host debate is sensitive. Only when our banks are European in both their success and failure will we reap the full benefits of the banking union. And the banking union requires making hard choices and reaching difficult compromises, and so far we have not been able to do that. In short, if we want to successfully navigate a changing banking landscape, we first need to complete the post-financial crisis agenda. But if we want our banking sector to be well positioned to embrace the latest technology and support the green transition, we can and must go beyond it. As I mentioned, digitalisation is fundamentally changing the financial landscape. Technology companies, large and small, are increasingly offering financial services. This increases competition, but it also makes value chains more complex, making it harder for supervisors to have an overview of the risks. It can fundamentally change banking service supply chains, introducing new critical suppliers and a new category of risks that must be managed. It also has consequences for the business model of traditional banks. New fintechs unbundle the full service model of traditional banks, and big tech companies enter financial services using data and extensive customer information. Last year, the Commission put forward a digital finance strategy. We want financial institutions, capital markets, consumers and the economy as a whole to be able to make the most of new technology, such as blockchain or artificial intelligence, while addressing the risks. Today I want to focus on how the Commission is addressing cyber risk, which is key to banking supervision. According to research by the ECB, there was a 54% increase in the number of cyber incidents reported to the ECB last year compared with 2019. Indeed, the financial sector is the sector that faces the most cyber attacks. A digital financial system needs to be resilient to these risks. The Commission's proposed regulation on digital operational resilience, or DORA, defines common rules for all parts of the financial system to ensure that they can withstand all types of ICT-related threats. The rules we want to put in place are robust, consistent across the financial sector and proportionate. The draft regulation also addresses the risks of large technology providers that offer ICT services, such as cloud computing, to financial firms. Third-party providers of ICT services should be subject to EU-level oversight. We're working hard with the Member States and Parliament towards a swift agreement on the new rules. Making sure banks have the right procedures in place to be resilient to cyber risk must be a top priority for banking supervisors. And supervisors need to understand the technologies, such as artificial intelligence, that banks are using and monitor the risks they can create. Beyond these new risks, technology could fundamentally change the financial system. The very nature of money is changing. Money is increasingly digital as cybercurrency and stablecoins gain in popularity. But for now, this digital money is private money. So, central banks, including the ECB, have been thinking about central bank digital currencies, whether we need digital money backed by a central bank in the way that cash is, and how that would be designed. According to the Atlantic Council, 87 countries, including the United States, China, Japan, the United Kingdom, are at various stages of looking into central bank digital currencies. 7 countries, mostly in the Caribbean, have already launched CBDCs. In the European Union, the ECB has begun the investigation phase for a digital euro. The Commission is working closely with the ECB to explore what a digital euro could look like, and we are carefully considering the potential impact. A digital euro could bring benefits for citizens. We already face situations where cash cannot be used, like when making online purchases, though a digital euro would be a complement to cash and not a replacement for it. A digital euro would give consumers more choice about how to pay and therefore increase financial inclusion. People who currently don't have a bank account or have difficulty accessing cash due to bank branches closing could be brought into the financial system. Beyond the benefits for individuals, the digital euro could also support our ambitions for the EU retail payments market. It could help private intermediaries develop truly European payment solutions using European infrastructures and standards, and it could support instant payments. It could also help us achieve some of the political goals of the European Union, such as support for innovation, supporting the digitalisation of the economy and strengthening the international role of the euro. But there are big questions to address as well, like what would the impact be on banks? How do we ensure that privacy is protected? How would we keep this digital system secure? Introducing a digital euro would be a big decision and one that we would have to get right. And if we decide to go ahead, then the digital euro will have to be well designed. So I look forward to continuing our close collaboration with the ECB on the next steps in this project. The other fundamental transformation confronting us is the transition to climate neutrality. Economy, society, politics all will need to change. And to meet our sustainability targets, all of our policies must contribute, including in the area of financial services. I mentioned earlier that we use the opportunity of the new banking package to ensure that banks take account of ESG risks. This transformation will not be easy, and that's why the Commission's Sustainable Finance Strategy is so important. It helps all sectors, whatever stage in the journey that they're at, to reduce their negative impact on the climate and environment while managing climate risks. The ECB's economy-wide climate stress test, released this September, shows just how important addressing climate risk is. If we do nothing to tackle the climate crisis, we risk knocking 10% off European GDP. The climate stress tests by the ECB, as well as those that we in the Commission have mandated the European supervisory authorities to carry out, are a key way to figure out where the vulnerabilities in the financial system lie. We want to know how climate change affects financial institutions, the exposure of banks to biodiversity loss, environmental degradation or extreme weather events. At the same time, we want to know the impact that financial institutions themselves have on the climate and environment through their financing decisions. Looking at climate risks from both these perspectives will help us make the financial system more resilient to climate change and enable it to make a full contribution to the climate transition. In conclusion, we have not yet finished implementing the post-financial crisis agenda, but we must complete the process for the sake of financial stability. And we must finish implementing the reforms for another reason, to allow us to move on from the past and look to the future. There are many challenges ahead. Cyber risks and climate risks are just two. But there are also huge opportunities to build a financial system that delivers for both people and the planet. As regulators and supervisors, we must help the financial system navigate these choppy waters as we safeguard financial stability. Thank you for your attention.
Thank you very much, Commissioner, for your insightful contribution. Let's follow up with a few questions. You analysed how ESG risks are implemented in the bank's risk management. How do you plan to advance risk management practices and prudential supervision in that regard?
Well, this is a work in progress. The 2019 banking package already integrated certain ESB elements into the prudential framework, so large listed banks will have to publicly disclose ESG risks from June of next year. And we have an EBA mandated study into whether differentiated capital requirements are needed to better capture environmental and social risks. And the results of this will be hugely important. You know, the Commission already had a public consultation on potential further measures aimed at better integrating these ESG considerations into the overall prudential framework. And this came after the adoption of the European Green Deal. I think the importance of holding on to the risk-based approach was certainly something that was stressed, so that we have to take account of ESG risks, but that this shouldn't lead, for example, to a decrease of requirements where there's no evidence that the green nature of the assets leads to a reduction of financial risks. So it's a complex discussion. Our latest proposal takes a step further towards the inclusion of ESG considerations into the prudential framework. We're introducing specific requirements for banks to implement the systemic management of ESG risks. And we're also giving supervisors the tools they will need to enforce these requirements. You know that we've asked the EBA to bring forward their work on dedicated capital rules and ESG risks to June 2023. That's 2 years earlier than planned, because we need evidence to assess the implications of introducing, for example, a brown or a green or a social factor into all of our planning. And as we expand the scope of ESG disclosures to all banks, so not only large and listed ones, while ensuring proportionality for the smaller banks.
You pushed for expanding AML CFT rules to the entire crypto sector. How do you walk the tightrope of mitigating the risk without stifling innovation?
Well, I suppose the overall comment I'd make is that innovation and regulation are not enemies. They should actually be friends. So if we have smart, forward-looking regulation, this can create the conditions where innovation flourishes. Regulation, in my view, is the key to provide legal certainty, and the legal certainty is needed by market players, both the new and established market players, and we need to confidently develop and offer new innovative products and services. Regulation, I think, is also vital to manage risks and therefore to build the trust that investors and consumers need to fully buy into these new offerings. And I suppose that's the rationale behind our approach to crypto assets. Our framework for markets in crypto assets will introduce a bespoke regime for previously unregulated crypto assets, including stablecoins. And I think this will provide legal clarity. It will help to boost innovation. And at the same time, solid rules for issuers and service providers will prevent abuse, fraud and theft, protecting investors and safeguarding market stability. And already the Member States and the European Parliament are making progress in their negotiations on the draft regulation supervision for markets in crypto assets, and we're urging them to keep up the tempo so we can get agreement on these new rules this autumn. Because crypto assets are evolving fast, enabling innovation, homegrown firms to enter the market while also attracting retail investors. It is our policy and our duty as policymakers to put sound rules in place as quickly as possible. And then closely linked to this proposal is a pilot project for market infrastructures based on distributed ledger technology, DLT. This pilot will create a safe space for market players to experiment with issuing, trading and settling securities using blockchain technology. And again, the trilogue negotiations are proceeding well, and I'm hopeful of an agreement by the end of this year. The technology has the potential to increase efficiency, but we need to be clear about how it works in practice. So the pilot will allow us to test this in a setting that balances innovation and safety. It will run for 5 years, and at the end of that period, we will decide on whether to adopt our existing legislation to ensure that it's effective in fostering responsible innovation. So as of next year, market participants will be able to test the use of DLT on a large scale in asset classes such as shares and bonds. And this is a great opportunity, not only to give our capital markets a much needed push, but also in particular for smaller firms to attract new business.
Thank you, Commissioner. And one last question on the banking union. The European Parliament just discussed the 6th report on banking union, which stressed the need for progress. Will the banking union ever be completed, or will it be work in progress forever?
Well, look, it is work in progress, and we believe it has to be completed. The Parliament's annual report on banking union comes at a time where the sense of urgency to complete the banking union has eroded, and we've seen political stalemate over the last years. What we need to do is highlight that we cannot wait for another banking crisis to continue this work. And the Commission very much shares the commitment on the need to complete the banking union, and we appreciate the work of the European Parliament in calling for increased efforts to achieve our common goals. We want to strengthen the second pillar of the banking union and review the crisis management and deposit insurance framework, and also to build a third pillar of the banking union, a European deposit insurance scheme and a solution for liquidity in resolution. The Commission has, repeatedly stressed the importance of the banking union completion for the achievement and the progress of several other flagship initiatives, because the benefits of a more integrated banking union are widely recognised, both to promote financial stability, but also to look ahead and finance the necessary transitions, digital and climate change. So again, the Commission supports the efforts to create this ambitious work plan towards a steady state banking union, and we're ready to take our responsibility with concrete legislative proposals. It is really vital that discussions continue with the aim of reaching an agreement. And I would say to the point of your question, while the negotiations are difficult and the sense of urgency may have been eroded somewhat, our determination to complete the banking union is as strong today as it was when we made a decision that we needed the banking union. And frankly, we need it more now than ever because of the rapid change in the entire banking system and the financial world. So while it's difficult, we're determined to achieve it.
Thank you very much for your time, Commissioner.
Thank you very much.
Many thanks to Commissioner McGuinness. So we're back live now, and we will come to our second panel, which is on the very timely topic of climate change and whether banks and supervisors are prepared. This panel will also have an audience poll, and please also send your questions if you have any. This panel will be moderated by Irene Hemskerk, who is the head of the ECB Climate Change Center.
Good morning, everyone, and welcome to the second panel of the ECB Forum on Banking Supervision. With an excellent lineup of speakers, we will discuss in the coming 75 minutes the very topical issue of climate change. Are banks and supervisors prepared? As a quick introduction, I want to remind everyone today that only a few years ago, the discussion was still very much focused if and why climate change is relevant for central banks and supervisors. So today, I'm so pleased that we shifted the discussion to how well are banks and supervisors prepared. So after a summer where we have witnessed so many natural disasters with heat records, wildfires, and floods, we are already confronted with the impact of climate change. And the climate summit of the COP26 that is going on in Glasgow today and still this coming week, this will also hopefully lead to strong commitments of governments to transition our economy to net zero. All of this will have an impact on the financial sector, on the work of banks and supervisors. So I'm very much looking forward to discuss this topic with the panelists today. Let me introduce them. We have Sarah Breeden, the Executive Director for Financial Stability, Strategy and Risk at the Bank of England, and a member of the Financial Policy Committee. I also want to mention that Sarah has been the Bank of England representative at the network of central banks and supervisors for greening the financial system, the NGFS, and she has been leading the pioneering work on climate scenarios. I think you could almost say she's like the founding mother of the climate scenarios. Secondly, we have Sonia Gibbs. She's a managing director and head of the Sustainable Finance Institute, Sustainable Finance at the Institute of International Finance. I have known Sonia for some years now, and I can say that she really played a key role in getting climate change on the agenda of the IIF and really helping its members progress on this theme. Then we have Isabel Matas Ilago. She's the managing director of BlackRock, global head of its firm's official institutions group, and a member of its geopolitical risk steering committee and global operating committee. You probably all have seen the 2021 letter to CSOs from Larry Fink, where climate change was really the main theme. So I'm very much looking forward to hearing from Isabel the broader market perspective on climate change and the relevance it has for the financial sector. Then we also have Frank Alderson on this panel. He has been a member of the executive board of the ECB since December last year and vice chair of the ECB supervisory board since February 2021. Given the topics of today's panel, I also like to mention that Frank has been the chair of the NGFS since its inception 4 years ago. And ever since, the membership have grown from 8 to 100 members last week. So this group has really taken up its membership and its role globally. And besides, Frank also co-chairs the Basel Committee Task Force on Climate Risk. So what is the program for the coming 75 minutes? We will first discuss with the panelists the current state of play. Secondly, we will look ahead what is needed to really set next step and a progress for bank and supervisor on addressing climate change. And besides, we would also like to hear from you. So we'll have a poll question between the first and the second part. And we have a Q&A at the end, as is mentioned by Connie already. So please put your questions already in the chat if you have them. So let's get started. What is the current situation? Are banks and supervisors prepared? Sarah, I want to give you the floor first. How are banks prepared in the UK, and what has been the Bank of England's approach in getting banks ready?
Thanks, Irene, and it is a real pleasure to be here. Thank you so much for inviting me. And it's a really timely question for us here at the Bank of England. We brought in supervisory expectations for managing climate change back in April 2019. We have told UK firms that they need to have embedded those expectations by the end of this year. And we've just published a report that sets out where firms are and where we are going to take our supervision from here. So it's a great opportunity for me to give you the headlines. I'd summarize that the firms have made good progress, but there's a lot further to go. and some firms are showing more ambition than others. The supervisory expectations that we brought in cover governance, risk management, scenario analysis, and disclosure. And we've seen a step change in board and senior management attitudes to climate change. It isn't in the corporate and social responsibility box anymore. It is firmly a strategic issue. And we saw that in COP last week with so many financial institutions signing up to the Glasgow Financial Alliance for net zero. But what's clear is, while that's great in terms of strategic ambition, further investment is required to embed climate change in business as usual risk management. Data is a challenge and is always said to be, but what we've seen is that there are some firms out there that are being creative in how they use the data that does exist in order to make progress more quickly. So what we're trying to do is encourage firms to continue to be strategic and ambitious, but use judgment, expertise, and all the tools available to make this a part of how they make every single decision. How are we helping them get ready at the Bank of England? The first thing we're doing is setting deadlines. People react to deadlines. Those deadlines come in our supervisory expectations. They also come in our climate biennial exploratory scenario, kind of the climate stress test that we're doing. We're also sharing best practice. We have a climate financial risk forum that's a public-private partnership that aims to share best practice in order that no one has the excuse that they don't know how to manage climate-related risk. And I'd encourage everybody on this, listening to this, to have a look at what the CFRF have produced. There's draft risk appetite statements in there, really fabulous summaries of the data that are available, and through our own communications, through Dear CEO letters, we're highlighting what good practice looks like. We're underlining the need for ambition and creativity. Roughly right is okay, precisely right when it's too late is not a good outcome. And then the final thing I'd say, Irene, is we're practicing what we preach. We are managing our own balance sheet with climate change as a factor, and we are disclosing. And so, having gone through the process ourselves as a bank, we are able to understand some of the challenges and how to be creative in meeting them. But anyway, bottom line, great progress, but loads more to do.
Thanks so much. I think we all recognize that. I think I hear a bit of echo. Is it better? Oh, yeah, it's better now or not? Okay, I'll give it another try. Yes, it's good now. Thanks so much, Sarah. And I think what I take from your intervention, it's that it's maturing, it's getting more serious, it's on the board agendas, but it needs to be addressed really in the heart, in the day-to-day business lines, and setting deadlines and sharing practices is a good way to motivate. Sonia, I'm curious to hear from you. What is your view on the preparedness of banks, and are supervisors intervening too much or too little, and what areas would need further guidance?
Thank you so much, Irene, and thanks to the organizers for including the IIF here. I wanted to say up front that what I'm going to say broadly reflects the views of IIF members around the world, and that we've got 450 members in 70 countries, including many in emerging markets. So it's been a really interesting time of exploration for us all. Just 3 points on the preparedness of banks. First, that climate risk is increasingly embedded in bank business models, as Sarah mentioned, and banks see client engagement and financing the transition as key elements of climate risk management. Second, that the toolkit for climate risk analysis, management, and reporting is really evolving rapidly, with scenario analysis as an increasingly used tool and quite distinct from stress testing. And third, there's growing potential, clearly, for supervisory intervention on climate risk and in areas like transition plans and portfolio alignment. and such interventions should be carefully calibrated and ideally aligned across jurisdictions. So on the first point, banks being increasingly attuned to climate risk, I wanted to mention we did a 2021 survey with EY of chief risk officers and found that over 90% of bank chief risk officers view climate change as the top emerging risk over the next 5 years, and half of them think it needs their urgent attention over the next 12 months. And that is such a change from just in 2019, when less than 20% of CROs saw climate risk as an urgent priority. The banks we talk with are increasingly actively undertaking internal scenario analysis, committing to net zero goals, and working very closely with clients on their environmental impact, and not just developed country banks, but emerging market banks as well, which is really rewarding to see the effort here. So client engagement, financing the transition, those are becoming fundamental tools to help for banks to help quantify and mitigate climate risk. And both of these, of course, have been big themes at COP26. So effective engagement, supporting clients in transition do two important things. First, they provide banks with the information they need about supply chain risks. And second, they mitigate transition risk by helping turn the brown to green. So my second point here is that the toolkit for climate risk management is developing rapidly. And we did a stock take this year of scenario-based climate risk management practices with 20 major global banks. We find that banks as well as supervisors are conducting scenario analysis to bring future climate risks and opportunities to today's business models. So it's a real shift in thinking. Industry and supervisory goals are ultimately aligned to enhance risk management practices and promote better strategic thinking on climate risk management. And most of the banks that we surveyed are already using climate scenario analysis for internal risk management as input to the strategy component of their TCFD disclosures and to inform corporate decision-making more broadly. We see a lot of peer-to-peer engagement here, which is very interesting. You know, banks are normally quite competitive about their practices, but there's a great deal of information sharing and knowledge building here. And of course, the NGFS climate scenarios are emerging as a common reference. 40% of the banks in our survey already use the phase 1 scenarios, and even more will be utilizing phase 2. So my last point here is on supervisory intervention. You know, you asked too much, too little. Supervisors can offer clear guidance and expectations on how banks should approach climate change. They can promote alignment of market practices with jurisdictional frameworks like the TCFD, now also the Task Force on Nature-related Financial Disclosures too. Supervisors can create platforms for capacity building and public-private collaboration, like the new International Sustainability Standards Board will do on disclosure. And critically, supervisors can drive international collaboration and alignment. But just a note of caution here, while scenario analysis and disclosure standards are very helpful tools, our bank membership broadly believes that climate-related regulatory capital requirements are not appropriate at this time, given the long time horizons, the evolving science and analytical tools, the data gaps, and risk of unintended consequences. So looking ahead, plenty of guidance welcome in different areas on the technical elements of forward-looking risk assessment, on a common international approach to the design of supervisory exercises. Goes without saying, we need better availability and quality of data, though that mustn't slow us down, as Frank has often said. And on a related note, we need better climate reporting from real economy firms to support bank risk management. And finally, we need a clear link between climate risk assessment and portfolio alignment, which will help form the basis for transition plans. I'll stop there, Irene. Thanks.
Thank you so much, Sonia. It was good to hear that it's also at the financial sector, they're really making progress. To hear the 90% percentage that chief risk officers see this as the theme for now already to address climate change. I think this is a very strong development and just emphasizes that the topic is growing and growing in importance, and rightly so. So I would now like to move to Isabel to hear the market perspective. So where do we stand in tackling climate change and biodiversity loss via the financial markets? And are efforts and pace sufficient?
Thank you very much, Marine. Good morning to all. It's a real pleasure to take part in this panel with such inspiring leaders in this field. Can you hear me?
Sorry, Isabel. I think there is something wrong with your sound, or am I the only one? No.
No. Okay.
Let's see what we could do about this. Sorry for this. Could you try one more time, maybe? I think it's not fixed yet. What we could do is I move to Frank first and we try to get this fixed. Would that be good? Because it would be too bad if we don't hear what you say. So Frank, can I give you the floor then first on, I think the ECB published its supervisory guide last year, just like what Sarah said with expectations, where should we go? What are the main takeaways on the preparedness of banks based on the results of a self-assessment that took place last year? Are there any good practices you have seen?
Well, thanks a lot, Irene, and sorry, Isabel, that now suddenly the order has changed. I thought it was very good that I would speak as the only male in this panel at the very end. But you know, technique stands between good manners. But great to be on this panel. Thanks a lot for having me. You ask about what the ECB is doing. Before I get to that, let me just celebrate a couple of things that Sarah and Sonia have said. I mean, it's absolutely clear that some page has been turned. I was at the COP last week, and there were many CEOs of the world's biggest financial institutions, and they would not have necessarily been there in former COPs. So I think this underlines that people understand that this is crucial, that this will not go away, and that there is an incredible amount of urgency to this question. So I think that is very good. Now, but as Sarah said, and I think Sonia also, there is still so much work to be done. There is still a lot to be learned. There is still a lot of capacity that needs to be built. And all these curves, these learning curves, they need to be very steep because of the extreme urgency of the climate crisis that we are already in today. Now, what has the ECB done? As you rightly said, Irene, we published a guide with supervisory expectations in terms of climate and environmental risk management last November. We asked the banks to self-assess against these expectations. We asked the banks then, on the basis of the self-assessment, to come up with action plans. We engaged with the banks. We gave them feedback, all the banks, in feedback letters. And actually, in some weeks' time, we'll indeed, and we are a little bit, because some weeks behind the Bank of England, we will publish a report on the findings of these self-assessments. There's more going on, so I will come back to that. To the outcome of the self-assessment in a second. There's more going on because, as you might know, we also did a macro stress test, a climate-related stress test some time ago. Next year, we will run a micro prudential and bottom-up stress test. We just published the methodology of that. So there's a whole range of activities that show that also this supervisor, the SSM, takes this very seriously. It's one of our top priorities, and banks will notice in all these various activities that we continuously press on the importance of this. Now, in terms of the self-assessments, I think that the very good news is that banks have been very, very open and very sincere. So I think this is very much to be applauded. I don't think there has been any greenwashing, if you like that if you allow me to use that term, in their assessing where they stand. So I think that is very much to be applauded. That's the good news. The bad news is that actually none of the banks under our supervision is even close to complying with all our expectations. So there is still a lot of work to be done. We do see good practices, and we will share those in this report that we will publish in some weeks' time. And the good news there is that we see good practices in different banks, different business models, and different geographies. So this tells us that this is possible, that it's not some kind of like an impossible ambition that we put there. It's possible, it can be done. But as I said, none of the banks is close to complying with all our expectations. So there is clear work to be done. Now, maybe with my hat on, as you introduced me like that as well, as the chair of the NGFS, maybe to also say that this is now indeed, and you mentioned this in your introduction, Irene, there is actually no supervisor, no regulator around the world that still doubts whether they have a role to play. That I think that it is now so clear that we all understand that this is within our mandate, that we need to help banks to make this change to incorporating climate change and environmental change in their risk management, to grab the opportunities, and this is maybe the last point I want to make at this point, to align their balance sheet with a Paris compatible transition path. Because I think this is really the buzzword that came out of the COP. Sarah, you already mentioned the GFANZ, the Glasgow Financial Alliance on Net Zero, the commitment that an increasing number of banks and financial institutions more generally make voluntarily to have a net zero balance sheet by 2050. Now that is very important in and on itself, but of course 2050 is still, what might it be, 4, 5, 6 CEOs down the line. So I think the teeth of this GFANZ initiative is not just this commitment by 2050, but also the intermediate commitments to have 5-year intermediate transition plans, and the commitment to then annually report on the progress towards these intermediate goals with clear KPIs. Now, I think that is key. It's key in making sure that the financial system actually greens together with the broader economy. There is a clear causal relationship, of course. There cannot be a green financial system in a non-green world, but also the other way is true. The world cannot green without the financial system playing its role. So only because of that, I think it's key. But it's also key for banks to manage their risks and to actually grab the opportunities. And maybe to close off here, I think it is, as I said, very much to be welcomed that there is this voluntary initiative. But I do think here in the EU, it would be very helpful if this were to be backed up by a legal requirements for all banks to have Paris-compatible transition plans, because this would actually enhance the pressure, but also help us as a supervisor to play our role. And let me stop here for this moment. Thank you, Irene.
Thank you so much. So really, like turning the page. I think that's what I hear you say, but we're not there yet. And it's good. It's a bit of a teaser to the poll question we'll be having in a few minutes on transition plans. But first, I really hope that Isabel is well connected, because I'm really looking forward to hearing from you.
I hope so too. Can you hear me okay now?
Yeah,
yes,
much
okay.
better.
Wonderful. So, good morning, everybody, and it's a great pleasure to join all of you on this panel. So listen, I frankly agree with everything that's been said before. The way we see it, there's been an absolute sea change really in the last 2 years in, number one, recognizing that climate risk is investment risk and macroeconomic risk, frankly, in many cases. And number two, accepting responsibility, accepting at least some responsibility for the outcome, for whether as a world we will indeed manage to avoid catastrophic damage. And these two steps, frankly, are huge ones. And we've seen this manifested itself in 3 ways. First is target setting. You've all mentioned the Glasgow Financial Alliance for Net Zero,
460 institutions, 130 trillion or so of assets that are now committed to down the road be aligned to a net zero outcome. That's remarkable. Equally remarkable, Frank, I'm surprised you haven't mentioned this because this is all you're doing, or at least you deserve a lot of credit for this. 100 central banks and supervisory institutions that are now a member of the NGFS and that have, over the recent weeks, published commitments to play their part. And that part will vary according to the institutions, but to play their part in delivering the right climate outcomes. So target setting is key. The second area where we're seeing this changes in flows, when you look at the flows of capital being allocated to the asset management industry over the past year in EMEA, almost half of them went to sustainable strategies, which is extraordinary. So the pickup in the pace of capital being allocated to sustainable strategies is several orders of magnitude what it was just a couple of years ago. And that's obviously very meaningful because then it starts influencing the cost of capital of companies based on whether they themselves are aligned to sustainable climate outcomes or not. And the third area where we've seen this sea change is in data availability. Today, something like 85% of firms in the S&P 500 disclose some kind of climate metrics. Firms supporting the TCFD now exceed 2,000. It's more than a doubling again in the last couple of years. And more and more of these firms not only support the TCFD, but actually report consistent with its disclosure framework. So no question that's a sea change. And the data point is a really big one because until recently, this was really a major hurdle to integrating climate consideration into the management of financial risk, and now, if anything, there's an overabundance of data. There's tens of thousands of data points that can be looked at, that can be incorporated, and if anything, this creates a challenge in and of itself, or an opportunity for those who can manage it. Having said that, and here I would really agree with what all the previous speakers have said, we're in the very early stages of this necessary evolution, and progress is not even across geographies and across sectors. So, when you poll big global asset owners and ask them like what share of their assets are allocated or managed sustainably or and aligned with climate targets, roughly 3/4 still are not. And Europe is far ahead on this. So if you take a global perspective, it's even less. ESG integration in banks. I mean, there's been some ECB work on this. The TCFD itself, yes, it's beginning to happen, but again, it's very much at its infancy. For us, this is one of the 5 priority engagement topics that we ask about in our stewardship activities with all the firms that we're invested in globally. And what's very clear is that most firms are only just beginning to set the right governance structure at board level, at management level to cope with climate risk. Most banks at early stages of setting their strategy, deciding whether they're going to exclude certain sectors or certain types of profiles of firms, and then risk management and collection of monitoring of climate metrics, target setting. All this is being done really on a very pilot basis, if at all. And that's okay, because it's hard to do, and there's a lot of learning to do. So this is not to say we should be depressed about the state of play. One thing that's of course very challenging for the financial sector as a whole to embrace this climate agenda is that the bulk of the emissions is scope 3, right? I mean, most banks or asset managers or insurance companies don't emit a lot of carbon by their own activity. It's really all about the activities that they enable through their provision of financing. And so in a way, the data set can only be as good as that of the companies invested in. But be that as it may, the direction of travel is highly encouraging. The last point I would say is progress is not even across the board. In terms of geography, Europe, in which I include the UK for the purposes of this discussion, is clearly ahead. And I think, again, credit to supervisor and regulatory pressure that has been, frankly, way ahead of the rest of the world. The rest of the world is stepping in, but it's a long journey, and obviously, the sooner you start, the more advanced you are. Secondly, there is a clear and I would say growing gap between public companies, publicly listed companies, and private markets. There's been enormous regulatory emphasis on the publicly listed companies, much less so on the private markets. This is a risk. This creates an arbitrage risk, and of course, the size of the private markets is constantly growing. So it's really important from our standpoint to take a whole system view of this. Otherwise, we're just going to see the polluting assets migrate from one part of the system to another. And then thirdly, and this hasn't been touched upon so much, but in the title of the panel, I believe there was a reference to biodiversity, or perhaps more broadly, what we call natural capital, which include biodiversity, deforestation, and then water resources protection. It is part of the picture, but it's much harder. Certainly for us, again, in our engagement with the companies we invest in, this is absolutely something we look at wherever it is material. And by the way, the WEF estimates that over half of global GDP is either moderately or highly dependent on natural capital. So this is not a small issue, but it's a lot harder to measure. When it comes to carbon emissions, well, it's easy what you have to measure. It's carbon emissions. It's for natural capital, the metrics are not as standardizable, and it's a lot more qualitative. So just to say, it needs to be part of the picture. We certainly do everything we can to make it part of the picture, but it's even harder than for carbon emissions. So let me stop here and maybe come back in a future round about what's needed to accelerate progress further.
Thank you, Isabel, and also for the people behind the screens for fixing your connection, because it was really a pleasure listening to you. It's good that you already sketched a bit the challenges, because I think there are really some ahead of us, and I think this is also a nice bridge to the second round of this panel. But what I really liked is that you said or firms are recognizing the risk, but also accepting a responsibility, because I think this is will be really key to move forward on this theme. Okay, before we move to our next round to hear, okay, what are the next steps? Let us move to the poll and let us hear from you. The question we have put up is, what is the next steps for banks to set up net zero transition plans? Frank already referred to it, others as well. Transition plans was really the buzzword in Glasgow. And also the European Commission included transition plans in the CRD/CRR proposal that was recently published. So the poll question is, what are the next steps? Is it enhancing client engagement? I think Isabel said it's not only, how do you include the scope 3 for financial firms? I think it's utmost important that we have a great, banks have a good view of how clients are working on this. The second option in the poll is hire experts and train staff. Well, there's a lot of knowledge and things to explore on this. So that's the second one. The third one is join the Net Zero Banking Alliance. This is part of the so-called GFANZ, a forum to accelerate the transition to net zero. and already 450 financial firms across 45 countries. And they are responsible for assets of 130 trillion dollars. So that's a lot. So client engagement experts, hire expert and staff, join the Net Zero Banking Alliance, or all of the above. So I'm curious to see if we have the poll results in already. Let me quickly check in the chat. No, not yet. But then I give you some time to think about it, because I think this is really important. Transition plan is really key. What Frank said, not only what are you doing, what is the CEO, the fifth or the sixth CEO doing in like 30 years from now, but what are you doing in 5 years, and how are you getting there to net zero, and what is your plan to walk away from carbon? Okay, we have the results coming in. I'm really curious to see that the winner is all of the above, so it's 61%, and that I think really resonates, I think, with all the messages the panelists have brought up so far. We need actions on all fronts, and we cannot wait. Like first collect some more knowledge about it, and then talk with your clients, and then join a bank, the Net Zero Banking Alliance. No, the majority, 61% of the poll results say let's go for all of the above. Well, that's a great start to move up to the next part of our panel, and that is, what are the next steps? Sarah, can I give you the floor again? How can we really push the system to where it should go, and how will the Bank of England contribute to that?
Brilliant, thanks, Irene. And I would say the main thing that we are trying to do is encourage people to turn pages quickly, to learn to speed read, so that the urgency of the situation is reflected in our actions, consistent with the poll results just then. So the first thing that we're doing is shifting gear in our supervision of climate-related financial risks. We're no longer just about enabling firms to meet those expectations. In addition, through our active supervision, we'll be looking to ensure that our expectations are met. What does that mean in practice? It means we'll be asking firms questions about how they are embedding it, and trying to ensure that the firms are being ambitious and using judgment, expertise, and creativity as they go about trying to size these risks. And importantly, what we'll be doing is using our supervisory toolkit, just as we do in all other aspects of our supervision. When things aren't where they should be and where more progress is needed, that ranges from requiring remediation plans to thinking about whether we need formal reports to us on where firms are potentially even risk management and governance scalers, and in extremis, perhaps enforcement. But bottom line, shifting gears through active supervision to ensure our expectations are met. The supervisory toolkit obviously includes capital, and so what we have done is launch a debate on capital. Capital is there to absorb losses. Clearly, the consequences of climate change brings the potential for losses, and so what we are doing is starting a debate on how we might better use capital to support our aims. It's clear that it's partially able to capture the risk from climate change at the moment, both in terms of how firms assess their own capital, about the possibility of using scalers where firms are not managing risks well. But we're also looking to investigate kind of how capability gaps and regime gaps may mean that capital is not doing the job that it should. Sizing that is a complex task. We need to do it carefully because the unintended consequences could be significant, but reflecting the urgency of this issue, we've started a debate on it, and that debate will happen internationally as well. Third thing we're doing, we'll be publishing our climate BES results later this year. We hope that will shine a light on where these risks are likely materialize and the change that is required if the financial system is able to steward the real economy on its way to net zero. And the fourth thing we're doing, picking up on the big theme, understanding where firms are on their net zero alignment, ensuring that they're thinking about these issues. The UK government has said it will introduce them initially on a comply and transition plans on a comply or explain basis, and then over time consider moving to mandatory. As supervisors, what we'll be wanting to understand is who's got one of those, who's complied, who's explaining why, and importantly, is what they're saying consistent with what they're doing? And then as a financial stability authority, adding that up at the level of the system to see what that's telling us about the likelihood of an orderly transition. And then perhaps the final thing to say, Irene, is that we'll continue to work internationally and with governments, because this is a problem that we can only solve together. We need to solve it, as other panelists have said, all around the world, not just in the UK, not just in Europe. So we'll be sharing our learnings internationally as we have done to date, but importantly as well, working with government, because much of this is driven by climate policy with elected governments in the lead. And I think we've an important role to play in facilitating the dialogue between the government, the real economy, the financial system, and us as regulators of the financial system. There's a huge amount to do, but as I said at the start, this is urgent, so we absolutely need to get on with it.
Thanks a lot, Sarah. So shifting gear, I think you really explained how you're going to do this, and even starting the discussion on capital. I think then things becoming really serious for everyone, and net zero transition plans are, it's good to hear also that at the UK it's moving towards becoming mandatory in a comply or explain position. And the last bit I want to mention is that thanks for mentioning also the role of governments, because I think, just to emphasize it, they have such an important role to play to really steer us towards a global strategy on how to reach net zero, and the whole society and economies on this. So now I would like to move to Isabel. So what changes, I think you already touched on a few, but what changes do you see that need to happen outside of the banking or financial sector to really help banks and supervisors to get prepared?
Yes, certainly. So first of all, I think it's very clear that the supervisory expectations and their continued ramping up is paramount. And again, when you look at the global panorama on this, it's very clear that European and UK banks are ahead of the game. Why? Because their supervisors were ahead of the game and asking them to pay attention to climate risk. We very much hope that these ramping up of supervisory efforts can happen in a globally coordinated way, which seems to be the intention, and that's very encouraging, because obviously a lot of these groups are global, and it's important for them to be able to have a unified framework as much as possible. Obviously, talk of capital requirements, yes, it focuses the minds, that's for sure, but for us, it makes us a little bit nervous as well, given how nebulous, frankly, the measurement of risk in banks is at this stage. So it seems to us that there's quite a lot of steps that need to come ahead of that in terms of, gathering the right metrics and and setting targets and so forth. And certainly it's very hard to do. We've been working for the past year ourselves on measuring the temperature alignment of our portfolios. There's lots of methodologies. You can come out in totally different places depending on the methodology. So, the same would be true for any bank trying to do this. And so there's clearly a role also for supervisors in helping guide what's okay, what's not okay as a methodology, because right now it's frankly a bit of an open field, and so some guidance there would be helpful. But I think that the most important point here is that I would make is finance cannot be the main enforcer. At the end of the day, most of the emissions are outside of the financial sector. They're in the real economy, and it's the real economy that needs to transition to a less carbon-intensive model. And for that, we need the right policy incentives, both on the demand side and on the supply side of energy consumption and carbon emissions. And it can be via tax, it can be via regulation, it can be through any means. But if it is not economically profitable to do the right thing, the financial sector will struggle to support that effort towards net zero. If you consider that, according to the IMF, as fossil fuel subsidies are around $6 trillion annually. This is why often it looks like carbon-intensive activities are cheaper than the greener and cleaner equivalent. Until it remains more profitable to invest in dirty activities than clean ones, the role that finance can play is going to be limited. So right now, I think it's really important for everybody to execute on the great targets that they've announced, and that applies also to, I would say, mainstream government policy, so that we can all get to way below 2 degrees of global warming. And finance will respond to that, because corporates will respond to that in the real economy, and then things will happen much faster.
Thanks a lot, Isabel. Policy incentives are indeed, I think, a very important topic to mention. And I'm also curious to hear from Sonia now to see, I think Isabel mentioned something, well, before we move into the capital sphere, we need measurements and metrics and also the global response. So curious to hear from your side, Sonia, what are really the next steps to set now?
Such a good question, Irene, and gets to a common theme that's been running through our discussion today. Can we agree on how we should be assessing climate risk and opportunities? What are our goalposts? How do we measure them, both for risk management and to channel financial flows? And who's in charge of making sure that banks get there? So the short answer, I think, is that we really need to identify common elements of information that can be linked across both voluntary and regulatory initiatives aimed at disclosure, target and commitment setting, monitoring and evaluation, and ultimately capital allocation. And that's really a tall order, given the sheer number of frameworks that are trying to do this. Even if you leave aside the regulatory and supervisory initiatives, which there are plenty, there are jurisdictional approaches to steering the financial sector, or not steering in some cases. There's also, of course, GFANZ and all of its component parts, a new expert group there that's going to roll up into the FSB, as well as the very wide range of frameworks supported by, for example, philanthropic foundations and NGOs, for example, science-based targets. So the bottom line is that we need to have a unified goal of driving real economy transformation, not just financial system resilience or portfolio decarbonization, although those are critical. Real economy levers that work across all sectors, like carbon pricing, disclosure mandates, or specific directives aimed at polluting sectors. Those are going to be the most effective complement to policies geared toward the financial sector. They're working hand in hand, as you say. And they'll also help the financial sector set targets and provide appropriate incentives to help banks reach their goals. So just going back to your metrics question, I think it's key to ensure that metrics are relevant, of course, to a bank's business model, strategy, and balance sheets. You got to work through the challenges of underlying data, and this is improving and changing very fast. We need to ensure that the facts are consistently and credibly delivered, and ensure that I think that a range of metrics, and whether that might be reducing carbon intensity or an implied temperature metric or others, that this range is used for different purposes, horses for courses, to avoid picking winners. And this is particularly true in areas like forward-looking alignment and analysis, where there are a lot of different views on what the right approach is. And banks, of course, will have clear views on which metrics makes most sense for their particular business model. But the key in measuring portfolio alignment, I think, regardless of metric, is going to be to judge whether a given portfolio really contributes to the fight against climate change. Will it have a real impact on greenhouse gas emissions? And one of the key question marks, of course, is who gets to decide that. So judging portfolio alignment, I think that it will affect how capital is allocated. It brings in the whole taxonomy question, as well as engagement and stewardship, as mentioned earlier. And of course, all of this scrutiny is going to intensify reputational risks and concern about greenwashing. And that's why it's so critical that there be agreement on yardsticks internationally. In terms of targets, it's going to be tremendously helpful to kind of clarify the links between this alphabet soup of commitment frameworks, including GFANZ in particular, all the constituent alliances within GFANZ and SBTI. The net zero frameworks, Frank mentioned interim goals with these requirements and clear KPIs to keep firms in line with the goals and set accountability standards. These have got to be meaningful and ultimately influence actual emissions reductions in the real economy. And I wanted also to mention here the work of the Task Force on Scaling Voluntary Carbon Markets and its new governance body, the Integrity Council for Voluntary Carbon Markets. Just to note that high integrity carbon credits can be a very important complement to emissions reductions along the path to net zero, while also protecting natural capital and steering flows toward climate vulnerable emerging markets. And a last point on incentives you'd asked. There's clearly a whole range of incentives, and the key is that these be aligned. So financial firms help incentivize their clients and counterparties, and vice versa. This shouldn't be underestimated, the degree to which clients incentivize banks to change. Clearly, there's the whole regulatory, supervisory, policymaker incentives for financial firms. And, just to reemphasize the points that we've been making here, clear, real economy climate policies at the government level are ultimately going to drive transition from the bottom up, enabling finance to do the same. And banks, of course, are a key catalyst of change in the economy, but it's important not to overplay that card. At the end of the day, as Isabel noted, and you too, Irene, government policies are going to play the largest part in transitioning the economy.
Thanks a lot, Sonia. And it's good to hear all the developments that are ongoing at the moment. And I realized if you really want to be up to speed with everything, it takes a lot of effort. And I think this is also relates to the point that Sarah mentioned, shifting gears, right? Because this is what needed. And I really hope that although there are some unclarities, that we can still move on, because it's of course there are questions out there, but I think it's the topic is just too urgent to slow down and see and wait for perfection. I think this is also something that Sarah said at the start. So Frank, I would like to move to you now. So what do you see as next steps, and really to address climate and environmental risk? What is the ECB doing about that? Are transition plans relevant? What could really help on this front?
Thank you, Irene, and thanks a lot again also to the fellow panelists, because I think very, very important points have been made, and I think we are all looking at the same direction. Maybe to just remind everyone who is looking of the urgency to start with. 1.5 degrees means 70% more of the floods and the fires and the droughts that we're seeing today. 2 degrees means 200 to 300% more of the floods, the fires, and the droughts we see today. Today, we are not on a 1.5 degree path. We are not on a 2 degree path. We are on a 2.7 degree path, and some think that is optimistic. So that is just as a reminder for all of us where we are. First point. Second point, I completely agree with all of you that in the end, this is going to be driven by governmental policies. Governments have signed up to the Paris Agreement, not central banks, not supervisors, not financial firms, not real economy firms. Governments have. So it's true that if some people were to say that it should be the financial sector policing the world, moving to net zero, that is beyond what one can ask from the financial sector. Now, the financial sector is responsible for managing its climate and environmental related risks. That is clearly what needs to be done. And climate change, both in the physical, but certainly also in the transition aspects of it, is not something that will just start on the 1st of January 2050 because the Paris Agreement thought in terms of 2050. That is today. Today, we are being confronted with cities that say we don't no longer want diesel cars. Today, we are confronted with building regulations all around the world saying that there should be energy efficiency. So all these manifestations are today. And this also means that these risks that we always refer to as climate-related and environmental risks, they translate into very traditional existing risk categories. This is already something that has come out of the work of the Basel Committee. So it feeds into credit risk, it feeds into market risk. And that is also looking at the future without putting a concrete timeline on this, but this is also why it is very much in the logic of it all, that in the end, of course, this will feed into capital requirements because capital is there to be set against material risks, and these are material risks. Now, that is a former point, an additional point I wanted to make. Some other reactions maybe to what has been said. I think, Isabel, you're so right in pointing out that this is beyond just the climate sphere. We need to talk about natural capital. We need to talk about biodiversity loss. Actually, there was a whole day last week in Glasgow dedicated to deforestation. There's a key role also for the financial sector to play. And what we cannot do is to now say, okay, you know what? We are very busy. There's many challenges. Let's face climate change for the next 10, 20, 30 years. And then afterwards, we will, pay attention to some of the other pressing issues. That is just not a luxury we can afford. These risks are there. They will be manifesting themselves. They are manifesting themselves, and they need to be looked at in their more holistic interaction that they have. I was also thrilled to hear the representatives of the financial sector saying that actually in terms of data, we are moving, or we have already moved, to a situation in which there is an abundance of data. Now, of course, we need to harmonize. Taxonomies are very important. The NGFS is trying to do what it can in terms of coming out with a data repository where you will have a website in which you can access in a dynamic way as many databases as there are. But it is no longer acceptable to just kind of like sing the old song of saying, there's no data. And sometimes I challenge bankers into to just make that point as well when they say it, and then I ask, so did you at least make the list of things that abstracting whether this is already available or not, or easily available or not, but the data sources that you would need, the data that you would need, and I still speak bankers that have not done that basic homework, and that is just not longer acceptable. I think in terms of maybe since you mentioned this, Isabel, and I didn't want to be too self-congratulatory here at all, but it is true that the now 100, and actually we already received another application since that. But the now 100 supervisors and central banks around the world that are united in the NGFS, it is true we have now committed in a commitment that we published last week, but indeed there's also many of these individual commitments by individual members. This is significant. It's significant because it says something. It says something. This is no longer something that is just a voluntary thing by the willing that are members of the NGFS. This is something that we actually by committing say this will not go away. This will not go away, and you know, I can just subscribe to what Sarah says in terms of, you know, how the SSM looks at this. The time of awareness creation is actually over. You know, the Paris Agreement was signed 6 years ago. The Club of Rome was active in the 70s. It's not that, you know, it is acceptable to say, well, you know, I've just started to think about climate change. This is very much here and now, and I think the role of supervisors is now to actually ensure that expectations are being met, ensure that risks are being managed, ensure that transition plans are increasingly going to be aligned with climate policies. And that brings me back to the very beginning, that governments in the end will have to make, but will be increasingly making, because that is something that we can be sure of. Maybe one more element that has not been mentioned, but which I think is a very important driver of transition risk, because we always think in terms of transition risk of governmental policies, but it is also, and I think this point was already made, stakeholders and clients of financial firms that increasingly are just requiring this. And the last element that I want to put to that, which was already mentioned by Mark Carney in his Tragedy of the Horizon speech, is the litigation risk which is out there. There is increasing climate and environmental related litigation around the world, increasing successful climate related litigation around the world. And this will also put pressure, set deadlines, and create transition risk. But you know, transition risk is also a stark reminder that if you manage that by moving from you know, a fossil-related balance sheet to a more sustainable 21st century ready balance sheet and business model, you can also take all the opportunities that are out there. Over to you, Ari.
Thank you so much, Frank, and thanks for all the 4 panelists. And I think I really see, I feel the energy here, see that we have to move up on this theme. And although there are many challenges everyone raised, but the commitment to address the issue, the urgency, of course, we would need some other conditions. So if I think a bit about the urgency we are facing, I think I can say I'm conditionally hopeful, because we need to have first the conditions filled as well, but everybody's working on that. But still hopeful that because of the energy I've been getting from these panelists on things that are moving, that there is data, that there are commitments on transition plans, that there are developments on the legislation front. Also, I think on the Basel Committee, it's good to emphasize that they are really working on embedding it in the whole framework, Basel core framework. And this will hopefully lead to more international convergence at this front. And the NGFS is, I think, really a big engine behind this, to have all these supervisors worldwide working together on sharing best practices. So now we have, luckily enough, still time for a few questions. We had 2 coming in. I invite participants to put in more. The first question is, and I think we touched a bit on this. The first question is, it seems to me, this is from Jose Maria Roldan, it seems to me that things will get messier before they get better. Improvement will happen in the coming years, but clustering banks by which banks are greener and which banks are browner might be a bit random until best practices are extended. How can supervisors navigate these years of chaos, and how can banks do this? Sarah, can I give you the floor first to answer to this question? The years navigating through the years of chaos.
So I think I'd be a bit more positive than that. I think we will have a period where firms are progressing at different rates. That's what we've seen already in our analysis of where the UK banks and insurers are. As I said, there are some that are ambitious and are doing a better job now than others. And I think our role as supervisors is to get the laggards to be with the leaders, and to use a combination of stick and carrot. The carrot being the sharing of best practice and the kinds of products that the IIF have put out, that the UK Climate Financial Risk Forum has put out, that show institutions how to do a good job of managing these risks, and use a combination of those carrots and sticks, which is the usual supervisory toolkit of requiring remediation plans of the laggards and being prepared to use the other sticks that we have at our disposal to encourage everybody to catch up. So I don't know that I'd call it chaos. I would call it a period of convergence being required. There are a number of banks who for many years have run their businesses on this basis. What we all need to do is work together to embed the toolkit and to embed these issues in every decision that's taken. And if I might make a final point, which goes to the underlying theme that there's been through this discussion, how the financial system and the regulators of the financial system are a part of this, of solving this problem, but not the only part. I think a really important part of what we need to do in the next few years is highlight where we need greater clarity on climate policy from governments, where greater technological change is required, so that those issues can start to be addressed early. So I think it's incumbent on all of us to embrace this with an attitude of constructive engagement, recognize that kind of there are leaders and laggards, and work together to try and stop chaos happening and to move us forward in as coordinated a manner as is possible, given this is a profound economy-wide change.
Thanks a lot, Sarah. I like the constructive engagement, and I think you mentioned that like supervisors have a role to help like guide the sector in going there, but it's also up to the sector, financial sector, the banks and supervisors to highlight to politicians on the guidance they will need to move forward on this. Sonia, what would your outtake be on this one, on this question?
It's a really interesting question, the years of chaos. And I agree with Sarah and would be considerably more positive on this, because it's ongoing as we speak, right? So first and foremost, sort of target setting with clear yardsticks, progress reports, so it's a guide, to help navigate through the chaos. Second, I really would emphasize peer-to-peer engagement and bank-to-client engagement, leveraging all of this to develop the toolkit, because a toolkit that is sort of, if you will, open source, and has input from a great variety of banks and financial firms around the world, plus the input from their clients, is going to be the most useful in steering us toward our goals. And finally, I think, I'd highlight really honest and open dialogue between banks and their supervisors. And today is a really good example of that. It's happening all over the world in big forums, small forums. And I think it's really critical in moving us forward. And I think what's interesting about this discussion today is it really reflects the degree of commitment and passion that we all share in getting to these really urgent goals on climate.
Thanks so much, Sonia. We have one more question, and I see we're almost running out of time. So if it's okay, I'll ask the last question to Frank and Isabel, because this is more on the prudential framework. The EBA, the European Banking Authority, has a plan, aims to bring forward the assessment report on prudential treatment for ESG risk from 2025 to 2023. Is this timely enough, especially since results need to be translated into legislation, which will take more time? Do we lose this decade? And if we do, can we afford this? This is a question asked by René Smits. Frank, can I give you the floor first on this?
Well, if you think where we are, and you remember what I just said about the 1.5, 2 degrees, 2.7 degrees, everything that we do is way too late. We should have been doing this in the 70s or earlier, and we didn't. But now we are where we are, and we need to just focus on the future. And I think many great ideas have been mentioned here. I welcome the fact that the EBA has been asked to speed up. I think this is very important work because this was a little bit implicit earlier, but let me be very clear. We as supervisors don't like a capital framework that is not risk-based. So before you start playing around, and some of these ideas that are maybe no longer so much en vogue, but some years ago many people talked about green supporting factors or non-green penalizing factors. That is not the way we look at this. The way we look at it is that we need to have a clear view on where the risks are. But if we have a clear view on where the risks are, then the logic of the whole Basel framework, if you like, is indeed that this is reflected in capital requirements in the end. Now, any work that's being done to get a clearer view on risk differentials, and I think that the work of the EBA is important, is very much to be welcomed, and the earlier real data are available, the better. And thank you for this question.
Thanks so much, Frank. Isabel, I think this is very much in line with your earlier intervention on capital. What would your response be? I think you're on mute. Sorry.
Yeah, sorry.
Yeah, great.
So fully agree with what Frank had just said. I would just add two things. One is, so of course there is great urgency, but it's really important to realize that there shouldn't be a one-size-fits-all approach. Banks have very different business models. Some have greater exposures to sectors that are more important from carbon standpoint. Some have greater exposure to emerging markets where the data challenges are much greater, etc. So one should be cognizant of this, whether it's as a regulator or as an investor. One shouldn't expect the same thing exactly of every bank. They're not going to all be able to have the same path, and that's okay. That's in fact the essence of properly managing these risks. The other thing I would say, and sorry for going back again to the same point, but it's very hard to know what the risks are if you don't know if you're on a 2.7 degrees of global warming, as some have been warning we are on the basis of policies in place today, or if we're on a 1.8 degrees of global warming, which is where we are if you believe the pledges made at COP26, or somewhere in between. The range of outcomes is enormously different, and so the sooner we can get clarity on the policy path, the sooner the whole economy, both real economy and the financial sector, can measure and manage risks appropriately.
Thanks so much. I think this is also in line with what Frank says, that it should remain risk-based still, all the capital. This is like excellent timing. We're like 11:44 CET. I really enjoyed discussing this important topic with you. I hope you have inspired many participants today. Your messages did not only emphasize the severity of the challenges we face due to climate risk, and that action needs to be taken at all fronts, so politicians and also financial sector, but also what we do, I think, in our daily lives. But you have also helped us shed us some light on the road ahead. So let me end by using the quote of President Lagarde. She included in the blog last week, in the words of Antoine de Saint-Exupéry, the time for action is now. It's never too late to do something. So after these last words, I would like to thank the panelists one more time for the excellent contribution, say goodbye to everyone, and give the floor back to Connie. Thanks so much.
Fascinating discussion indeed. Thank you very much to Irene, and thank you to all the panelists. I'm sure we could have gone on for a few more hours on this topic, and I'm sure this is not the last discussion on this topic. Now we will take a short break until 12 CET, 12 o'clock CET, and then we will come back for our third and last panel. Join us then. Thanks. Welcome back, and sorry for the slight delay because of technical difficulties. Our last panel now will look at the ever-present question of how to achieve greater European banking integration. This panel will be moderated by Silvia Amaro of CNBC.
Good afternoon, I'm Silvia Amaro, correspondent at CNBC, and I would like to welcome you to this panel on the future of European banking. We will be discussing next steps to further integration, and in order to do that, I'm very pleased to say that I have with me four very special guests. They are Jean-Pierre Moustier, operating partner and sponsor at Pegasus Europe; David Livingstone, CEO for Europe, Middle East and Africa at Citi; José Manuel Campa, Chair of the European Banking Authority; and John Berrigan, Director General for Financial Services, Financial Stability and Capital Markets Union at the European Commission. Thank you all for joining us today. Now, I would like to start our conversation by looking at one of the most controversial subjects in the banking union, and that is a European Deposit Insurance Scheme, or EDIS. We're actually running a poll on this subject, and I will be focusing on that in a moment. But for now, I would like to start with you, John, and asking you if you think that now would be a good moment to revisit the proposal that the Commission made back in 2015 for a European Deposit Insurance Scheme.
Yes, now would be a good moment. I think there have been many good moments in the past, so this is just the latest good moment to look at this, because as I think we have made clear from the Commission side, that we see this as a missing part of the banking union architecture, an important missing part, which influences the effectiveness of the other two parts. So we're very happy to have this SSM in place. We're very happy to have the SRM in place. But without this last part, we don't think the banking union is going to function efficiently. Why do I say that? Well, I think it's for two reasons. One, there's a sort of principal reason that if you are presenting the banking union as a single jurisdiction, then all depositors should be equally protected across that jurisdiction. And the way you do that is through having a European deposit insurance scheme. The second is one of more of efficiency. It's about aligning incentives within the system. We have collectivized the way in which decisions are made at supervisory level and in the need at resolution level, but we have not yet collectivized how we manage the costs of those decisions. And that can create certain, how do I say, tensions within the incentive structures of the banking union as a whole. So I think it is a good moment to do it. When you say revisit, I guess you're asking me whether I think the same proposal should be put on the table again. Well, we liked our proposal. We still like our proposal. We still think that the full loss sharing model is the one that should be in place. But we recognize that there are other views around the table and that there is more consensus around a liquidity-based model as at least a first step. So in 2017, which was about two years after we launched the first proposal, we pretty much accepted that we might move towards this hybrid model of a liquidity first, followed later by a loss sharing model. For us, it would be suboptimal, but okay, if this is the way the consensus is, we are more than happy to push that route. But we do need to make some progress here on the deposit insurance scheme, because as I said, it is the missing piece, and it sort of completes the architecture and makes sure that all parts of the architecture work optimally. So in short, yes, this is a very good moment to revisit it.
And actually, when we compare 2015 with Europe now, one of the big changes is, of course, the next generation EU funds. And when this decision was made back in 2020, it was described as a historic step for the bloc. So I would like to ask you, Jose, whether do you think that that big decision that the bloc took in 2020, and these funds are a sign that the bloc, in particular the euro area, is ready to have new talks on a European deposit insurance scheme?
Well, good afternoon, first of all, to everybody. Thank you for inviting me. I think that the next generation EU is clearly a sign that Europe is ready to make bold steps to move towards the European project. That's why I very much share Sean's view that now is a very good time to revise this opportunity to do this as part of that European project going forward. Now, I think that one of the key components to allocate European funds across the European market is to have efficient European level financial sector intermediaries, both banks and markets. And the banking union is one of the key components on that because it facilitates cross-border integration of European financial through banks. And as Sean said, I think it's important to keep in mind that until we finish edits, we can't really say that the other two pillars are working to their potential. And it's important that we continue to have the full conclusion of the banking union so that we can really have a full implementation of the possibilities, and particularly, the degree of cross-border banking within the union, particularly within the Eurozone, remains lower. I think that we all anticipated it would be in 2013 when the banking union got started. And I think it's important that we reflect on that fact ages later, and we continue to push to finalize the banking union so we can have more private risk sharing.
Right, you mentioned there how important the next generation EU funds, but back in 2020, the difference there was the fact that there was political willingness to take that, as you described, bold step. Do you think, Jose, that right now there is a similar level of political urgency to also address the fact that the banking union is not completed?
Well, we'll see. I mean, clearly we're in a moment in which it's transitory in a number of countries. We have an interim government in Germany. We have elections coming up in France. Those are two very big countries in this process. But at the same time, we have a commitment from the president of the Eurogroup to try to continue to pursue this agenda. So I think it's important that he wants to pursue the agenda. It may not be immediate, but at least we should make sure that we keep it at the top of the list, so that when the consensus, or as you said, the momentum and the political momentum is there, it takes place and it's implemented as soon as possible.
Right, let me turn to you, David. And given your background at Citi, I was just wondering whether do you think a European deposit insurance scheme could actually help the work of non-European banks in the euro area?
Sylvia, I think it of course can. I mean, primarily EDIS is directed at retail banking and within the union and for European banks. I mean, competing from outside the Eurozone or outside the union in retail banking is difficult, particularly cross-border. So I think it is primarily the benefit of EDIS will be for European competitive institutions. But I do want to pick up on just a couple of points that Sean and Jose have made. One being your question around the model and whether the model of EDIS should be a full loss or liquidity-based model. It's worth remembering that the US Federal Deposit Insurance Scheme took 50 years and 150 different proposals before it was successful. So I don't think we need to be too negative about the need to have a debate and some time to reach the conclusion. But I also think that Jose made an important point, which is that for the financial sector broadly, the combination of banking reform and markets reform and further integration is really those happening together will be really the test of whether there'll be full delivery of further integration within financial services in Europe and particularly in the Eurozone.
Right, and I would like to hear from you as well, Jean-Pierre, on this one, because obviously with Pegasus Europe being the biggest SPAC in the continent focused on financial services, how do you see a European deposit insurance scheme? Do you think there's any sort of merit in the idea also for your business?
The short answer is no. So let me take a slightly provocative approach here. I fully understand and agree with John's argument to say it would be good to have deposit scheme which could be the same for all European citizens. That's the point. Would that help in terms of cross-border integration on the banking side? I don't think so. I think the political cost of having a European deposit insurance scheme is going to be high. It might take still many, many years. And if we want to look at, what could be helping in terms of cross-border integration, that should not be, the first point to deal with. So, nice to have, probably very unlikely to happen in the short term. So we can look at other actions that the ECB has taken in order to support more integration, which can bring a European banking sector which will look like European. And I think one of the very important points and the difference between Europe and the US is that when you speak to investors, they look at Europe as the sum of countries. An investor will speak to you and will tell you, I'm investing in Europe, in US banks, but he will not tell you, I'm investing in European banks. He will tell you, I'm investing in a German bank, a French bank, an Italian bank. And so we need probably, to have more regulation, and the ECB is here for that, to have a more uniform banking sector so that investors, when they invest in bank, know what they invest about, and they can see that a bank in a country is looking exactly at the same in another country. This could help, but there are many other things to do in order to have a true European banking sector.
I'm glad you raised the differences there between the United States and the Euro area, and I'll focus on that in a moment. But for now, let me just share some thoughts from our audience on a European deposit insurance scheme. We have been asking the participants to answer the following poll. We asked them, is EDIS a reality within 5 years? The possible answers were yes, no, and if there is another financial crisis in Europe. So let's have a look at the results. And I have to say that 42% of our participants said no, that EDIS will not be a reality within 5 years. And that is really the majority of the answers. And then very close to that, 30% of participants said that there will be an EDIS if there is another financial crisis. David, what do you make of these results? Are you surprised that not many people are expecting a European deposit insurance scheme in the near future?
Frankly, no. I mean, if we think about some of the expectations and pace of some of the reforms generally around the banking union and also capital markets union, I think your audience is being probably realistic. That doesn't fundamentally change, though, whether it's a positive step for overall banking integration. So I'm not surprised by that. On the second bit, on the financial crisis, it depends. We sometimes look in the rearview mirror at the last financial crisis rather than the headlights of what could cause the next. And no one really anticipated the pandemic would cause a health crisis leading to an economic crisis that didn't create a financial crisis, in part because of the steps taken after the financial crisis in 2008, and the banking system, supported by new supervision and regulation, is certainly sounder than it was then. But I don't really see myself that a financial crisis is needed to trigger progress on EDIS.
What about you, Jean-Pierre? What do you make of these results? And indeed, that perhaps if there's another financial crisis, we will see a European deposit insurance scheme?
Well, I think that we have to look at what happened during the COVID crisis, which has been a catastrophe from a health point of view, but has been extremely well handled on one side by the regulator, on the other side by the governments, basically. And the combination of having a stronger banking sector, thanks to the actions taken by the ECB in the previous years, specific actions were taken which were not creating unanimity, to say the least, within banks in terms of postponement of dividend, which was as much a political issue than a proper regulatory issue in terms of capital. Action of the ECB to provide temporary relief on some of the regulatory constraints, and the government actions for the guaranteed loans to support the economy were absolutely tremendous, and something we would not have been able to expect. So I think when you look at this answer to the crisis and you put against that EDIS, you can see that EDIS would not by itself have been able to solve the COVID crisis, and that the government and the ECB have been super proactive and extremely brilliant about dealing with that. This is why I think the focus should move from EDIS towards more regulation, so that European banks, are much more similar, in terms of the way they are dealt with. So, which means more ECB and maybe less domestic central banks, and to have as well, a way to encourage a little bit more cross-border integration. The ECB has been doing that as well in a certain number of instances, in terms of recognition of badwill, in terms of temporary relief on models, etc., which are probably more important for us to move forward.
Right, and often we talk about, the risks of not completing the banking union to financial stability. But what we witnessed in the wake of the coronavirus was actually the system worked pretty well. So do you think, John, that perhaps there's a scenario where the euro area, the financial services in the euro area can actually flourish, even though the banking union is not completed?
Well, I think it's important to distinguish between two types of crises. I mean, the COVID crisis and the financial crisis that preceded it 10 years were very different things. I mean, the COVID crisis was a symmetrical shock to the economy, which did not involve the financial sector directly. And in fact, the story of that crisis was that the financial sector and the banking sector in particular were part of the solution this time and not part of the problem. So that's the story we tell. But let's go back to the previous crisis, 10 years earlier, which was a crisis which emanated from within the financial sector. And that's what banking union is about. It's about preventing and managing that kind of crisis more effectively. So I would not draw too many lessons from what we just had in COVID for what might be a future financial-centric crisis coming forward. Just to remove any doubt, I do not believe that EDIS is the silver bullet to a cross-border banking system in the EU. EDIS is part of a much broader series of steps which we have to work on, and Jean-Pierre raises some of those. But what I will say to Jean-Pierre is that if he wants to make progress on these other areas, we will have to make progress on EDIS as well. This is just the reality. The poll is interesting for me because it is difficult. It's a difficult moment. We're in a sort of bad equilibrium at the moment where everybody's stuck around the banking union and everybody is focusing on the costs of moving forward and not at all on the costs of not moving forward. Now, if you focus on the costs of not moving forward, then the second answer to your question, the one that says we have to wait for a crisis. I mean, why will we always have to wait for a crisis to make steps forward? Why is every step forward in institutional architecture only at the expense of huge damage to the actual banking system itself? So it seems to me this idea that Europe can only step forward and we must wait for the next crisis and before we make steps forward in institutional arrangements is pretty wrong-headed, in fact. Because if you think of what the banking union, we got part of the banking union because of the crisis, but actually we lost the integrated banking system in that crisis. So now we have the architecture for an integrated banking system, but we don't have the integrated system itself. So this idea that we should just sit here and do nothing while we wait for the crisis, and then when the crisis comes, we'll make great steps forward, it's a little bit inefficient for me as a way to make progress. So I think we need to focus much more in advance on the costs of not moving forward. And the cost of not moving forward is that we will not manage the next crisis as efficiently and effectively as we should.
Right, but let me challenge you on that point for a little bit, because history does suggest that the European Union tends to take bold actions in times of crisis. You mentioned, of course, the costs of not moving forward on this front, but do you think that the heads of state and finance ministers recognize the urgency in moving in this space?
I think the reality probably is at this stage, no. I think, and that is why we're having, as I said, a debate which focuses much more on the costs of moving forward and not enough on the cost of not moving forward. I suppose it's the job of people like myself and Jose Manuel and indeed Jean-Pierre and David to make the case the other way around so that people do in fact understand that getting these institutional changes in place ahead of the crisis is in fact the logical and efficient way to go forward, and not to wait till the horse has bolted before you put in place the defense mechanisms.
Right. On that point, let's focus now on the current landscape in the banking system, because we did see quite a lot of action in the wake of the virus from regulators, from central banks, and so on, to, of course, mitigate the shock. But do you think, Jose, how essentially has COVID impacted integration? Do you think that the pandemic has perhaps delayed that process?
Well, it's important, as Sean just saying, I think it's important to highlight that over the last 8 years, we have built the institutional infrastructure for a banking union, while at the same time we have observed that the banking sector remains more fragmented than it was at the beginning of this process. And that's a challenge for us. I think the COVID crisis has helped in the restructuring of the sector in some ways. Banks continue to enhance their operations, to reduce their cost base. We've seen some consolidation at the same time, but that consolidation again continues to be primarily around domestic lines in specific countries, and there's relatively little, not just cross-border consolidation, but increments on cross-border activity, and that's an area of concern for us as we go forward. I think that the crisis itself has not really helped the banks deal with any of their long-term structural challenges that they were confronting. And particularly in Europe, I will highlight two, which is mainly relatively low profitability. The return on equity of the banks in Europe has been low, particularly when compared to the US counterpeers, which was highlighted before as well. And the second aspect is the need to do a significant technological transformation, due to changes in technology. At the end, banks is an intermediation industry, intermediates in the financial sector, and like most intermediation industries in other sectors of the economy, it's being very affected by technology. And the banks need to invest in that technology, they need to transform themselves, be ready to compete with new competitors that may be bringing that technology into the banking sector. And that's a challenge that they need to confront. In that part, I think actually COVID has accelerated the pressure to do that of the banks, and at the same time probably has increased the bank's plans to move in that direction, which is a good step forward.
So just to clarify, would you say that the pandemic has actually boosted the argument for more integration?
Oh, I think for sure that the pandemic has boosted the argument for enhanced adjustment of the production of banks, particularly this area of the technological transformation. And that usually implies more integration because it requires big investments, big economies of scale, and size. There is an important component. So I think that has accelerated part of the integration. But unfortunately, as I said, what we have seen so far has been primarily at the domestic level.
Right. Let me turn to you, David, because we did see some authorities restricting intragroup distributions. Do you think that cross-border institutions have the ability to transfer sufficient resources in times of crisis like this one?
It can depend on structure, of course, and particularly subsidiarization versus a branch network. And I think the ECB and EBA have been very clear about the encouragement for European institutions to use that ability to have a branch network throughout member states and to move to that, recognizing that that's not easy if you're in a different structure today. So that does allow for greater flexibility of liquidity movement and so on. But I think it's worth reminding that it's not just on the basis of liquidity that banks either compete or respond to stress periods. So just going back to what sort of Jose was saying, that if you think about what banks are dealing with in Europe, even pre the crisis, they're dealing with being negative interest rates. They're dealing with low valuations in the public equity markets at below book value. They're dealing, as Jose said, with huge digital disruption in their core activities. So those are the issues that they're going to put at the top of the list and say, does cross-border integration help or harm that? And for a number of reasons, you could say that from an execution risk point of view, that's not what I want to do right now. If you're running a bank, and say, actually, I want to focus on these other things. And in an environment where certainly coronavirus, the pandemic, led to massive liquidity increases in banks. And indeed, that's one of the challenges. The challenges on the asset side of balance sheets at the moment and finding growth. And that ultimately comes back to the investability of banks. So yes, integration and going cross-border to compete might be helpful. It might be good integration from a cost-saving point of view, but it's not always going to be the case that cross-border integration is going to solve some of those fundamental problems that banks are exposed to.
Let me just make a side note here to tell our audience that if they have any questions, to send them over, because I will be opening the floor to questions a little bit later. But let me go back to that point of low profitability. John, in what ways could integration help with some of the challenges that the banking system faces at this point in time?
Well, like again, I mean, we have to be careful that we don't sort of start looking for silver bullets all over the place here. I mean, there's a lot of work has to be done in very many areas of the banking system. But in integration, we believe, I think Jose Manuel also will say, is part of the solution. It is not the only solution, but it's part of the solution. Because integration can allow, as Jose Manuel said, scalability, okay? It gives the banking system scale. It gives us a broader domestic market, a more accessible domestic market, and that allows certain efficiency gains. You know, the standard economies of scale, economies of scope discussion that I've been having since 25 years in the Commission. I think in particular today, what we're finding is that in the new prudential environment where banks are holding, of course, a lot more capital than they used to hold in the past, the management of that capital and the management of liquidity cross-border is quite complicated in the European Union. And this is complicated because of a legacy of the crisis itself, which has resulted in this famous home host discussion that we have, where we are, you know, we have a problem, let's say, in efficiently organizing capital across groups when they also have to cross jurisdictional boundaries. So if we can get somehow an arrangement whereby capital can be managed more efficiently from the center, liquidity can be managed more efficiently from the center, while at the same time reassuring those host member states to those banks that in times of difficulty, they will not somehow be left behind, then that would be another way of developing efficiency. So I think in these two ways, through sort of kind of operational efficiency and then this economies and scale and scope, this is how integration can help. Is it a magic sort of solution? No, but it will be an important contribution, I think, to making the European banking system more investable, while, of course, other structural reforms will also be required. And, of course, they will have to address the digitalization challenge, the climate risk challenge. So things which are not necessarily directly linked to integration, but integration, I think, would be a useful assistance in managing these broader reform challenges.
Right. Actually, I would like to focus now on some of the points that Jean-Pierre essentially highlighted earlier in the session between the United States and the Euro area. And so I would kindly ask our technical team to show a chart that our colleagues at the ECB put together for us, very kindly of them. And essentially the chart, which I hope you can see on your screen, highlights the total number of assets and credit institutions in the Euro area and in the United States between 2008 and 2020. And it shows very clearly that the US managed to consolidate while also increasing total number of assets. But that was not the case in the Euro area. So Jean-Pierre, are you surprised by that? And essentially, how did the US manage to make consolidation work?
I think that the big difference between the US and Europe is that the US is a truly single market, while Europe is not. There is a fragmentation, natural fragmentation in Europe. Is to address a client in Italy or in Germany, retail and corporate, you need to have a very, very specific offer and a very, very specific environment. While in the US, you have the same language, you have almost all the same rules from a tax, a fiscal point of view, accounting point of view, etc. So I think that naturally in Europe, the single market could work partly on the trade side, but does not work on the banking side per se. Which means that for European banks, it's more difficult to get critical size because the critical size needs to be done in market, but cannot be done on a cross-border basis with very, very digital synergies. And to go back to what was said, I think COVID has been a wake-up call for everybody in terms of our clients are going digital, our branches are closed, they're not coming there. How can we accelerate the transformation? And so European banks have to accelerate their transformation, which means more simplification of process, digitalization, basically automation. But they rely on smaller markets, which each have to have a specific solution, while the US has a big market where your break-even cost might be much lower. And so I think we are at a structural competitive disadvantage in Europe. Not to say that we cannot overcome that, but we have to be mindful of that. And clearly, we need to accelerate the transformation. I can see that moving from the banking sector to being a SPAC and investing in growth companies and looking at a new business model. The transformation of the banking sector is much more important than the integration. When you have a minimal critical size in the country, you need to hurry up massively in order to find efficiencies, better quality of the service of clients, and cost efficiencies.
Right, so you've highlighted there some of the structural challenges. But David, what other points would you highlight between the differences of operating in the euro area vis-a-vis the United States?
Your chart is interesting, but it does hide a couple of points. Firstly, that consolidation in itself isn't, as Sean said, isn't the silver bullet to everything. And the more important dimension there was asset growth, and that's clearly linked to economic growth over that period as well. And the US experienced higher growth in that period. But outside of the banking system, it was also the development in the US, and I think it probably even more starkly different, of the depth of wholesale and capital markets, which went alongside that period of asset growth in the US banking system. So the positive reinforcement of both bank balance sheet assets as well as the depth of funding markets available to participants in the economy, I think would really be the measure of distinctive strength of the US in that period relative to the EU. And that's why, going back to an earlier comment, that as we progress on further integration, banking union and so on in the EU, is not to forget the benefit that will come to the EU and the Eurozone from continuing the reform in capital markets. So because today, 3/4 of funding of lending, debt lending is on bank balance sheets. And that's a structural over-reliance on bank balance sheets. The other point about the US is worth remembering. In retail banking, the US remains a very fragmented and locally based. There are national banks, of course, but there are, as your chart shows, hundreds of thousands of local, well-supported operating banks. So integrated European banks don't have to come at the expense, maybe, of continued member state banks. But it really sets the objectives, seems to be that both of those would continue in a future construct within Europe.
So what would be your advice, David, to European authorities? What should they do?
Well, I think they doing what they're doing, but recognizing that, as I said, that the continued reform in both elements of both the wholesale and the banking markets will really be of benefit, to be positive reinforcement together, and don't let one go behind. But also, and I think Sean hinted a little bit at this as well, which is that don't lose sight of domestic reforms within member states that can also facilitate ultimate European integration, and keeping making progress on those points of harmonization, and the private markets will take the opportunities as they arise against those frameworks, which are undoubtedly more positive and encouraging over time.
Jose, what do you make of this advice?
No, I mean, I think, first of all, I take it very seriously, and I concur with most of what has been said. I think that the chart is very informative in highlighting also that the banking sector in Europe was bigger than in the US in 2008, and it remains bigger today, which indicates, as David was saying, that there is much more reliance on banks as a form of intermediation in Europe, and that's becoming relatively smaller than it was the difference in 2020 that was in 2008. Part of that was intended consequences from the crisis, from the 2008 crisis. Part of the reforms that were put after 2008 were actually to decrease some of the large balance sheets on some activities that the banks had that proven not to be prudent. But as we go forward, I think we need to work on building that re-establishment of the two pillars. And I'm not talking about banking union, well, three pillars of the banking union. I'm talking about the pillar of the banking union and the pillar of the capital markets union, and make sure that we're able to develop really fully functional financial markets that can complement each other. And I think that chart to me shows on the U.S. part of view the growth of capital markets and active capital markets are clearly complementary and do not come at the cost of growth of banking activity. On the contrary, they support each other, and that's very important as we go forward. So I think that's one part of the agenda that goes beyond banks, but it's important to continue, and I know the Commission is working hard on this, and we need to continue to pursue that part. On the banks, I would say that the second thing that the chart highlights clearly is that the trend towards consolidation or less number of banks is common. It's not European specific. It's really driven by more drivers that are prevalent both in the US and in Europe. I think, again, here technology plays a major role. And I just would like to highlight that one point that David said, which I think is important. Further consolidation and enhancement does not necessarily mean that there should not be a large presence of different banks and different business models within the European Union. That should clearly coexist. It just means that at least at what top level, we need to make sure there is adequate private risk sharing and the ability to transfer funds across the union effectively, so as to seek investment opportunities in any part of the banking union that arise, regardless where the savings are taking place. And there's like a room for that needs to be further developed.
Right. So, John, perhaps you could highlight a little bit the focus of your work at the moment and whether the Commission has these structural challenges in mind when preparing new proposals.
Well, let me start with this issue of the capital markets union. I mean, I think I agree with what David and Jose Manuel have said and what Jean-Pierre said. I mean, they are complements. We've always presented them as complements. I think they've not always been seen as complements in some of the member states. Some see this as a sort of zero-sum game. We do not. And the US is a good example of where a very vibrant banking system and a very vibrant capital market can coexist. So we need to get this point across more clearly, and we are trying to do that. In terms of the challenges we're addressing in banking, I mean, we have just completed the last part of the Basel reforms, which is the last part of the kind of post-great financial crisis reforms. And I think that brings to an end this particular chapter, which is the sort of recovery from the global financial crisis. Looking forward now, we're going to have to start focusing on some of these and I think, to be fair, analysts in the market have already moved on to focusing at some of these broader and bigger challenges to the banking system, coming from externally from issues like climate risk, but also the digitalization challenge, but also internally where regulation can help, but is not the main driver in terms of operational efficiency, cost structures, etc. of banks, which I think are a reform agenda which the banks themselves have to undertake. But in these other areas on the outside, like climate and digitalization, in the legislation we are putting forward, and these don't only apply to banks, of course, these are meta challenges to the system as a whole and to the economy as a whole. We are trying as far as possible in our legislation to prepare the banking system for the climate risks. So in our side, we are trying to inbuild into our legislation ESG factors, allowing the supervisors to ensure that the banks take those factors fully into account. On the digital side, anything we do always takes account of how the banks will interact with digital challenges. But I don't think in terms of, and I want to be clear here, that there are some challenges inside the banking system, which I think only the banking system itself can address. And that relates to the operational structures, the cost structures, etc., where the banks themselves will have to take charge. And we will do what we can in legislation to facilitate a vibrant, functioning banking system going forward. But I don't want to give the impression that the solution to all the problems in the banks are going to be delivered through the regulatory or supervisory field.
Of course, but it does have an impact. And actually, one of the main obstacles that people mention when looking at the banking sector in Europe is the fact that it is difficult to see cross-border mergers. What do you think can be done on that front, John? How can the Commission essentially support more cross-border mergers if banks decide to go down that path?
From the Commission's point of view, I mean, this would have to be done through the legislation we propose. And of course, we are trying to reflect the banking union in our legislation. So we have tried in the past to address this home host issue, as I mentioned before, by somehow recognizing the banking union, albeit incomplete, but recognizing in the legislation by allowing to some extent the centralization of capital management and the centralization of liquidity management at the parent of a group, of cross-border groups, helping therefore, making it more attractive therefore for banks to become cross-border. I have to say those efforts have not always been successful. The member states in the final decision have decided not to take those suggestions on board. We will continue to try to reflect the banking union as far as possible in the proposals that we put forward, try to reflect the banking union as a single jurisdiction in the legislation we put forward. But I have to be honest, this ultimately is a decision to be taken by the co-legislators. And at the moment, these suggestions we're making are not being taken up. And I think that is an issue. And I think legislation does need to be made more cross-border banking friendly.
Let me turn to you, Jose, on that point. And what do you think the ECB, as a supervisory, can actually do to support more consolidation in the bloc?
Well, I think that the ECB has to work with the regulatory environment that we have, right? And Sean just clearly indicated to us that there are difficulties in making that as friendly as it could be to facilitate consolidation of capital and free movement of liquidity. But the ECB itself can try to encourage groups to work within the regulation to do that. And there's been significant moves that have been put forward this year. Earlier on, they put some guidance on how they view M&As and how they would view M&A projects going forward, particularly cross-border ones. Andrea Enria has also made some important statements about how he saw the banks could engage more cross-border by either having contractual arrangements within the subsidiary framework to try to provide sufficient confidence to host regulators of the subsidiary that support would be there from the parent if needed or when needed. Also, he also highlighted the possibility that the branch network, and David made a reference to this early on, also has for facilitating the central management of capital and liquidity within the union. Those are steps that can be going forward. I think as the SSM becomes more and more established as the single regulator for the larger banks, and that's really respected and accepted by now in the financial sector, it'll become more and more obvious that they will have the ability to fully assess a group, how they operate within the banking union, and that will facilitate that cross-border activity. So I think of the day-to-day implementation of their supervisory practices, it's important that they need to signal, that cross-border activity will at least not be penalized, but on the contrary, if it makes sense from the sustainability and from the business model point of view of the bank, it should be pursued and encouraged.
Right. I would like to focus now on some of the challenges that will essentially pave the way for the future of the banking sector in Europe. But before I get to that, I just want to share one question that we've received so far from our audience. And please send more over if you have questions to our panelists. This one is from Jesper Berg, and he asks, isn't the probability very low that a deposit guarantee fund will ever have to make a payment given the depositor preference in the BRRD? Jose, perhaps you want to take that one.
Sure, happy to do that. I fully share Jesper's point of view. It's probably likely that the deposit guarantee fund will not be used in nothing else. We also have built this second pillar on resolution, right? One of the key features of that pillar on resolution is that for the large systemic banks, particularly, will be a resolution and no taxpayer money will be involved, and it's being built up of additional capital requirements. So it is true that the likelihood of uses may become lower over time of the deposit guarantee funds, but at the same time, it's not a question, I think, and here Sean can help as well, but it's not a question of how likely is it going to be used, but how palatable is for national authorities to accept that there could be some mutualization of that potential use if it were to be taken going forward. So I think it's the fear of that mutualization that is deterring more active movement in progressing towards a single deposit insurance.
Actually, I do have a question on that as well, because the problem with a European deposit insurance scheme is this difference of opinion within the bloc. We have this north-south divide, essentially. So how can the European Union square those differences, John?
Well, I think they can square them by pointing out that they're not there. In fact, the European Deposit Insurance Scheme is not designed for one part of the European Union. It is designed to cover all depositors in all parts of the banking union. So that's the main thing, is to simply deny that this difference exists. Okay, this is not, no one is creating a European Deposit Insurance Scheme to help one part of the banking union. It is there for all of the banking union. And of course, we all know how deposit insurance works. Deposit insurance it doesn't work that it covers the entire deposit base. It covers the marginal depositor. It is there to instill confidence in the system. You hope you never do have to use it. You hope that the system is so confident confidence building that you don't actually have to use it. But the fact that it's there is what, this is the paradox. The fact that you have it is what makes it never necessary to use it, but you must have it there. And as for the depositor hierarchy, of course, in resolution, we have depositors very much at the top of the hierarchy, and in liquidation, it's also there. But that doesn't mean you don't pay out. So the deposit insurance doesn't take losses, but the deposit insurance has to pay out after so many days. The insolvency can take months, can take years. So you still need liquidity in the system. So what I think Jesper is saying is that the depositing system will never take losses. I agree. I think it's very unlikely deposit will ever take losses. But we have a requirement under the law to pay out within 7 days. It's rare an insolvency is completed in 7 days, I can tell you. So that payout is still needed. And of course, if you want to use it for non-payout functions in some parts of the union, that also has to be there. So the depositor hierarchy protects the depositor insurance scheme from losses, but does not protect it from the need to pay out, the liquidity part. And that's one of the reasons why, from the Commission point of view, we are willing to say, okay, we will split this idea into a liquidity plus a loss sharing, because we know that the most important function of a deposit insurance is that liquidity phase. And therefore, that has to be in place. So I think my answer to your question is there is no difference. It's there for all depositors, but it needs to be there to give confidence to all depositors, north and south. Thanks.
All right, so let's switch gears now and focus essentially on some of the consumer trends that we have witnessed in the wake of the coronavirus, because they have supported indeed the rise of digital finance. And so this is definitely going to be one of the main themes for banks in the bloc as well as we move forward. And so I would like to ask you, Jean-Pierre, whether do you think that as digital finance develops even further, these talks on further integration will ultimately become obsolete?
I think that for banks in Europe, the priority, if you have a decent critical size in your reference market, is not to integrate further, but to transform. I think David mentioned that as well. So the transformation of banks is something which is extremely complex when you start from your legacy system, because you have to review your process, you have to simplify them, then you have to automatize and then digitalize. So digital finance is something where the banks are going to compete against a certain number of alternative proposals coming from fintech. But banks can actually partner with fintech, and in the development and our search for business combination, we have seen an extremely interesting business model where actually banks can use on a white label basis a certain number of fintechs, which can offer very good services on the wealth tech side, on the insurtech side, on the payment side. which give them immediately a product for an API, which can be offered to their client, which is extremely easy to connect to their system, will allow them to have a much better consumer experience, a much lower cost, and an ability to transform much more quickly. So I think we need to look at alternative way to accelerate this transformation, which can be a collaboration between a certain number of partners. And we can have as well more collaboration with banks on something which is linked, for instance, to the regulatory side on KYC, AML, where banks can pull together their resources in order to deal with a problem which requires critical size and a sharing of expertise. So that's the priority. We need to be a bit innovative about the way we apply these new business models.
Right, David, do you think that banks are ready to be innovative and join forces with fintech to develop their digital finance offerings?
So look, I firstly absolutely agree with what Jean-Pierre said in terms of how the landscape continues to evolve. That banks are not standing still, waiting for the next fintech to say, here's where we're going to disrupt your business model, and that's been the case for a long period. Some of the best innovations in payments, in cross-border payments, have come from the banking system. But there's no doubt that competition from fintechs is there, and it's good. But it has moved more towards the partnership model, where particularly at the boundaries of the regulated and unregulated system, that banks have the benefit of knowing how to operate and navigate and have a positive business model inside the regulated system. And Jean-Pierre mentioned AML and KYC, which is an area where there is still today sort of perhaps differential treatment between the regulated and the unregulated system. And we must remind ourselves that ultimately good AML and KYC procedures are for the benefit of the entire system, but the burden does at the moment fall more on the regulated system to keep that in place. So I think that overall banks are ready and capable of transforming, but as Jean-Pierre said, it is fundamental work based on upgrading of legacy systems and getting processes to match the client experience. But the great thing about the outcome of the response to the pandemic is that clients, retail and wholesale, are now very used to digital system, digital delivery, and all of that. If there was reticence, that has dropped, and so banks can be confident that their customers will want and respond to these digital capability and systems being presented to them.
Right, we have received another question from our audience, so let me share that one with you as well. This one is from Isabella Buffacci. I hope I'm pronouncing that correctly. And the question is, given that many European firms are global players, what can EU regulators and legislators do to help Europe's biggest banks become truly global players so that EU banks can globally compete with US giant investment banks and prepare for the arrival of Chinese giants in Europe? Jean-Pierre.
That a level playing field will be important. So banks have looked at, for instance, at a new regulation which could be seen as impacting more negatively European banks versus US banks, for instance, or a level playing field, making sure that when non-European banks come to Europe, they don't benefit from undue advantage, and if they reach a proper critical size, they will be regulated in the same way. But for a large extent, the regulator should do nothing. It's for the banks to act and for the banks to move. I think the ECB has done tremendously well during the crisis, is helping banks in a very pragmatic way. Now it's for the bank to get their business model and define where they want to compete. Would a European bank compete against US banks or Asian banks in their own turf in the US and in Asia? Which kind of competitive advantage do they have? Very little, except maybe to bring these clients in US and Asia into Europe. So I think European banks need to find their battles, basically, need to move and need to use their competitive advantage and need to develop. And the regulator, from my point of view, has done what is needed. Basically, we need more regulation. That's for me very, very clear, and less directive to have a more uniform system and to help the banks move forward.
What about you, Jose? What do you think could be done in this space?
Well, I very much agree with what Jean-Pierre just said. I mean, from our perspective, I think keeping to global standards in regulation, globally agreed international standards, and Sean mentioned before the implementation of Basel III. We're supportive, obviously, of the Commission's proposal, and we think that's going in the right direction precisely because this is one of the key features that allows level playing field in regulation across the world, so that then banks can find their own strategies and their own ways to compete in the different markets. So for us, continue to maintain that homogeneity in the application of regulations across the world that apply for large banks in particularly is fundamental. And this in the context of prudential regulation, it's the Basel agreements. In the context of the new areas in which we're going forward, we need to work on that area, whether it would be on the ESG front, on trying to identify regulation taxonomy there, or whether it's in some of the new technologies coming into place that are coming into the financial sector, like crypto assets and the MiCA proposal that's been put forward by the Commission. I think that it's important that we continue to keep clarity that a level playing field through regulation and implementation of global standards, and for us to work with the other regulatory agencies of the major financial countries around the world, to maintain and upgrade those global standards, but maintaining the level playing field is the key role we can play.
What about you, John, from the Commission side? What do you think can be done to make European banks truly global players?
Well, I think you have to remember what we're doing here. I mean, we are providing a framework. Okay, this is not an exercise in sort of industrial policy on our part. So I think what we can do is, structure the regulatory framework in such a way, and this is repeating what many have said before, in order to reduce fragmentation and give scale in the domestic market. So to create the European Union ultimately and the European area within the banking union context as the domestic market. Because what is different, I think, from some of our players and from US players and Chinese players is that they come with this big domestic market behind them and ours don't. However, is this, and here I agree with Jean-Pierre, is this what makes big players? No, this is a framework. This allows big players to emerge if they wish to emerge, if they can emerge. So it's not my job, it's not Jose Manuel's job, I think, to create global players. Our job is to create a framework which, as Jean-Pierre said, ensures a level playing field, ensures a less fragmented domestic market, and then we let the banking system participants find their way. And that's our job done.
Right, I actually would like to focus on another theme for the future of European banks. This is for the future of every sector, really. But when it comes to equality, I would like to come to you, David, on this one. What do you think could be done to make sure that there's a more equal representation in the banking sector? And how could that help integration in the euro area?
I suppose from talking a little as Citi here, I suppose we as a bank operating in over 100 markets around the world with physical presence feel as though, on various measures of diversity, for example, that there's we reflect that, and I think that is also the case within Europe. But most people look at diversity as contributing to diversity of thought, cognitive diversity, amongst other measures. And it's certainly been suggested that having broad perspectives avoids a single way of thinking, and therefore in times of whether it's risk-taking, whether it's in periods of stress, whether it's in just assessing next steps, that having a broad representation of people operating within banks is a good thing for achieving that. And so I think it comes more to individual institutions to make sure that they're reflective of the societies and the markets in which they compete, that they match the expectation of their customers and clients, and indeed increasingly their regulators with regard to the people they employ, but then also the culture that they develop inside their institutions. And ultimately, employees make their decisions about who they want to work with based on those dimensions. So I think it's constant work, but I would say that banks tend to be very open and vibrant places with very good careers and jobs, and therefore they are positive for attracting talent.
What do you think on this one, Jean-Pierre? Do you think that enough is being made to support a more equal representation across the sector?
No, I think clearly not enough is being made. And when you look at the split in terms of gender within the bank of the working population, it might appear superficially as more or less balanced. But if you go to the upper echelon of a bank, diversity is not sufficient. So we need to do more. I think banks are very focused on that in terms of ESG. That's in terms of governance, but also we have seen actions taken on environment and social responsibility side. So banks have to lead by example, and I think they understand that it is important. It's a people's business for a large part. So as such, it's of critical importance to attract new employees and to retain current employees that they move on this field.
What about you, John, from a legislative point of view? How can we fight this inequality in the sector?
I think the first point to make is that the banking sector is not unique in this particular challenge. I mean, this is a challenge which extends beyond banks to the financial sector and beyond the financial sector to the wider economy. So you can't just say that this can be something handled uniquely in financial regulation and independently of everything else. However, whatever is being decided more generally has to be reflected in the financial regulation. And what has been mentioned by Jean-Pierre about ESG is very interesting in this regard, because this S number, this S letter, we have always viewed it as a certain, if we think back to the past, S meant certain things, did not really include equality, did not really include diversity. I think S going forward, so as we start to build social taxonomies and other things, the issue of diversity in particular, and not just gender diversity, but ethnic diversity and the wider concept of diversity, I think will become more important and will, I think, begin to be reflected more in legislation. And if you listen to the conversation in the United States around regulation, particularly around market regulation, this idea of human capital, these ideas around the structure and the quality and variation in human capital is becoming, and quantitative targets in this context are being discussed. So I think there will be a role for regulation, but it will not be, a uniquely an issue for financial regulation. It'll be for regulation across the piece.
Right, as we are approaching the end of our session, I would like to look at the legacy of the pandemic to the banking sector. And we know how big of a landmark the 2008 crisis was and what that meant for regulation in the European Union. So, Jose, when you look at the current crisis, at the pandemic, what do you expect will be the legacy for the sector from a European perspective?
Well, that's a big question for concluding, but let me try to be brief, if I may. First, on one direction, the area of regulation, I would say that we already can say that the crisis has shown us that a big part of the regulatory framework that was built since 2008 until 2020, when COVID started, has helped us to manage the crisis from 2020 until today. So in that sense, we can feel comfortable and happy that the work that had been done over the last 10 years was worthwhile to some degree, at least, because it certainly has proven useful, both from the institutional infrastructure that was created in Europe, where the EBA is one part of the infrastructure that started in 2011, to the regulatory framework that was put for banks. So that has been one good aspect. The second aspect, maybe just to be a little bit more cautious, is that we don't know yet what the legacy will be to banks from the damage that the crisis has caused to the economy, or the damage that the crisis is causing to the economy, if I may, because we're still, we're talking about a new wave in many parts of Europe, obviously, of the COVID, so it's still ongoing. But even if we were not to continue ongoing, we know that the last year and a half, there's been significant disruptions to the productive sector, to the economy, to many firms as a result of that. We also know that the actions taken by monetary and fiscal policies have been very helpful in covering some of that damage, but some of the damage will continue to exist. So we are constantly calling on banks to remain cautious in assessing what the credit quality of the counterparties are, particularly as we go forward and as we expect that it should happen, the exceptional measures both on the fiscal, so the public guarantees, and the monetary part put forward by the authorities will start to be removed. So I would say, we need to continue to be cautious on that to try to assess what the impacts will be there.
What about you, Jean-Pierre? What do you think will be the big legacy from the pandemic? And are you worried that we will see a wave of non-performing loans in the European Union?
I think, first of all, there are different impacts. First, an acceleration of the client behavior. So that's something which is irreversible. And I think banks have made in a year much more progress than in the past 5 years before the pandemic. So that's something which is key. The second thing is, the unbelievable answer of both the regulator and the government in order to tackle the crisis, and the coordination between the regulator and the government was absolutely extraordinary when you look at it. And that's probably a lesson for the future. And the third is, the banks would not have been in such a strong position if we didn't have all the work, as Jose mentioned, which had been done after the great financial crisis. So we were, to a certain extent, lucky, and I'm not sure it's the right word to use, to have been going for the financial crisis, to have a very strong banking sector. But what is still a bit strange is that we have not seen yet the wave of defaults that everybody was expecting, a consequence of the actions taken, and probably, despite the fact that it's an extremely grave medical and social problem, the bank balance sheet will be in better shape than what we were expecting, thanks to the government support.
What about you, David? Tell us, what do you think will be the legacy from the pandemic? And I would also like to get your thoughts on the non-performing loans. Whether do you think this will be an issue for the euro area in the coming years?
I'll do the second one first, which is that, of course, banks need to keep a focus on the NPLs. But as Jean-Pierre said, the levels were not as they were certainly anticipated in the early stage of the crisis, in part because of very significant government intervention in economies. We'll have to see how the economic recovery plays out. Inflation is on the agenda that it wasn't in a way even 2-3 months ago. Supply chain disruption, all those things can lead to a different assessment of credit quality and so on. So I think that movie's not over. I think we just need to keep watching that, but it's certainly at a position which was better than anticipated a year ago. To me, the great legacies will be two. One is already mentioned, which is that the operation of the banking system positively as a transmission mechanism for government and supervisory intervention, I think has worked fantastically well in Europe, and that is a legacy of confidence and operation that should be taken forward. And the second is, I think, is associated to that, which goes to trust. So I think whether it's the regulators, whether the policymakers, or indeed the clients and customers, the banking system, I think, operated well, and that trust dividend, if you like, can be taken forward for the next stage.
What about you, John? I know that the European Commission was very happy with the next generation EU funds, but do you think that the legacy from the pandemic will be just limited to that big step?
Well, I think if we make a success of the NGU, then perhaps not. But we must not get ahead of ourselves. First things first, we must make a success of the NGU. So if down the line we see that this money has been used in a way that promotes reform, promotes productivity, promotes economic growth, then you can have that discussion about what next. But let's not jump ahead. Let's get the job done first. In terms of NPLs, I think it's right to say there's no tsunami. So the tsunami did not appear. We now need to watch that there's not, however, a sort of gradual surge over the years to come as the measures are gradually withdrawn. So maybe not a tsunami, but let's be careful. And just to be a little bit different, I mean, of course, I agree with all the other speakers on the legacy that we can draw. But I think one lesson we do need to draw is that the nature of the crisis we just experienced, as I said earlier, was different to the one that we experienced in 2008-9. And while we are very happy that the measures we have taken so far did in fact leave the banking system in a much better shape, this was not a crisis centered on the financial system. And we shouldn't draw too much confidence from this, that if the next crisis is one that's centered on the financial system, not having the banking union completed, not having all these reforms in place could still leave us vulnerable. So I'm very happy with the way the banking system performed. I'm very happy that the work that the banks and the regulators did in advance contributed to that, but just not draw the wrong lesson from it, that somehow everything's fine now and we can stop worrying about challenges facing the banking system. This would be a mistake, I think.
Right, and on that note, on that key warning, I would like to thank all our panelists for joining us today. And of course, a big thank you as well to our audience for taking part, for sending questions. We hope you enjoyed the discussion and of course, the whole of the ECB forum over the last 2 days. And I'll see you soon.
And thank you, Sylvia, and thank you to all the panel members, also from here in Frankfurt. Great discussion, and obviously some more work to do in the future, and work continues. So we have come to the end of our conference, and we thank all the speakers for their thoughtful and insightful contributions. We hope to see you all at the next Banking Supervision Forum, hopefully in person. And with that, on behalf of the ECB Banking Supervision, I would like to thank you all for attending remotely, and a big thanks to the organizing committee here, especially to our ECB Supervisory Board member, Kerstina Fjochnik, who had chaired the organizing committee. I wish you a very good rest of the day. Goodbye.